everybody. Welcome to the game plan. We've action-packed. I'm pumped today, guys, because we have the Federal Reserve later. We just got ADP private sector jobs numbers at 8:15 a.m. At 10 o'clock, we got the JOLTS numbers. We've got earnings from SMCI, AMD, Starbucks, all getting crushed here this morning. And you know what this does for me? It gives me opportunity. And opportunity comes when you wait and are patient. So we're going to get right started here on the day. Let's take a quick shot to Lawton right there. Good job, man. Right over here we go. Let's jump into the action, right? So first and foremost, we're going to go here to the market blast. I did do a market blast this morning because I want to cover the key data points that have come out. So down we scroll here. And by the way, all of this information is available on our website, posted even before I do this game plan, and then I go into in-depth analysis. So number one, ADP private sector numbers came in at 192,000. That is stronger than expected. So again, that's a positive number. Now, whether or not it carries over to the jobs number on Friday, the non-farm payrolls, we're going to find out. Expectations were for 183, so it wasn't a massive beat, but it was a beat nonetheless. Semiconductors are on fire in terms of going down like a ship. All right, we have semiconductors like Supermicro Computer missed revenue numbers. Now, they actually beat earnings and raised guidance, and some people are scratching their heads saying, well, why on earth did these stocks, or why did this stock collapse when they raised guidance? The answer is very simple. When you have a company that goes up hundreds of percentage points on the year, on this year alone, and hey, we're only May 1st. By the way, welcome to May 1st today. But you don't have any error or potential. Like, you cannot slip up on any number to justify the lofty stock price. And so that's what happened. They missed on earnings. And the problem too is that if you miss on earnings, but then you're like, oh, but don't worry, next quarter we're going to do great, our revenue, we're going to raise our guidance. It kind of builds a mistrust, right? I mean, if you miss on earnings, but then you're like, oh, but don't worry, we'll show you the real stuff in a couple months, it just makes investors feel iffy. Like, really? Are they really serious? Or are they just raising expectations to try to cushion the drop in the stock today, which is down about 10%? All right, Advanced Micro Devices, they honestly had a good quarter, but the stock has been so vertical that it's just hard to justify unless they come out with something even better. So they raised their numbers on their chips, expectations for revenue, but it wasn't enough for Wall Street. And this is the thing. I talked about this and I warned you guys for so long, and congratulations if you heeded some of these warnings, that these AI plays were getting too lofty and that they were going to come in at some point, and now we are seeing that come in. Starbucks. Now, this one's a big one for me. Usually, Starbucks isn't a big mover on earnings. This is down 10% plus on the day. You don't see that very often, folks, down 10% on the day. The kicker here is they really had horrendous numbers. And I was thinking about this, and I said to myself, Starbucks. So I know people that literally will get their Starbucks and avoid even eating. Like Starbucks is number one. And if you're seeing Starbucks starting to struggle, what does that tell you about the underlying economy? Well, for me at least, it tells me that the consumer may be struggling. Now, is this partially due to China? Yes, it is. But there's an underlying element here that there is a little bit of a stall out in the consumer. And we've seen this from other big names as well. There are other names that are struggling. We're going to talk about a few of those in just a minute. Pinterest was one of the positives here. Pinterest rocketing on earnings here. That stock, again, if you looked at that, compared it to Meta. Meta was vertical. It was like this, right? Vertical straight to the upside. Pinterest was like this. It was kind of down. It was maybe off the lows a little bit. Huge difference in what expectations were, because one stock was at a crazy valuation up here and Pinterest was down here. Lower expectations. They were able to beat those expectations. The stock went up beautifully. If you watched Trading the Close yesterday, I gave you live a short trade that I had set before I went on Trading the Close with Tony. That nailed it, and I actually made money on the pullback. We'll talk about that in just a minute. Okay, enough of this, guys. What I want to do now is we're going to do the spin. We had a year of Trading View, I believe. So a year of Trading View up for grabs. Let's do it right now. And don't forget to email Lawton@verifiedinvesting.com if you are the winner. And the winner is, let's see what we got here. Robinhood. There you go. Robinhood. Very cool. So congratulations, Robinhood. Reach out to Lawton@verifiedinvesting.com. He'll get you all set up with a year of Trading View on them. They're one of our best sponsors, along with many of these other ones, NordVPN, iTrust, as well as Lux Algo, and many others. So congratulations and thank you guys, all the sponsors, for donating what you guys have. All right, so what we're going to do now, guys, is we're going to go right into the charts and take a look. So SMCI, this is the chart pre-market of SMCI. This, if you watched Trading the Close yesterday, it was one of the most amazing shows because we watched this volatility here. And the volatility on SMCI was incredible. It initially dropped, then it surged up to $940. It then dropped to $720, and then it's kind of petered out to $776 currently. All right, now one of the amazing things, and I was talking about this on Trading the Close yesterday, is that we had a head and shoulders pattern. Now I'm going to draw the head and shoulders over this chart because I don't want to kind of take away what I have here. But basically what we had here was a very classic head and shoulders pattern. I believe, get my drawing tool up here. I believe that we had shoulder, head, and shoulder, and then breakdown right here. But the point here, again, is that when we retraced up, there was a neckline right through here, okay? We retraced right up to $940, and that was the level of the retrace to the neckline of the head and shoulders. That happened after hours. You could see the frustration. I even wrote something on the screen that I can't repeat in words. But the point being is that the price went there, and then it began to collapse, and it literally went from $940 down to $720 there. So pretty wild stuff. Now, looking at this chart, what do we have? You guys know this. We have a classic channel. Channels are becoming more and more important to me in swing trading and day trading. All right, so number one, we have this high right here of this big candle, and then this low, and this low, and then this high, and this high, and this high. So you're very clear, and this is a perfect parallel, meaning I'm using the parallel channel drawer in TradingView. But what does this tell me about a downside potential target? Over the next week or two, if this thing falls down into this lower level down here, which is right around $600, that might be an opportunity for me as a swing trader. Now, as a long-term investor, honestly, I think it's going lower. I do. So, like, it's not something that, for me at least, I'm going to buy and hold for a long period of time. But I might be interested as a swing trade right at that 600-ish level based on this channel. And obviously, that would be a pretty lofty sell-off or hefty sell-off on the chart. All right, AMD. Let's flip over to AMD. Then we'll get into some of the other things, the other earnings as well. We did have, by the way, MasterCard reported today. I'll touch base on MasterCard in just a minute because I do think, again, it could be a warning about the consumer. Last I checked, the stock was down. All right, here's your chart on Advanced Micro. Look at that drop over there on the pre-market and after-hours data yesterday. It has recovered a little bit off of its lows. So we did see it as low as about 144. It's back to almost 150 here. You are seeing a small bid coming into the market as investors are buying the dip on some of these names. However, what do we have here? These are my big levels. All right, I have the first level and the second level. They're very close together. These are two levels that I'm going to be watching over the next little bit of time. The first level, again, it comes in right here. There's a little flat top here, right through here. This is more a day trading level for me. So if it pierced 140, 140 would be my day trading potential level for a quick scalp or day trade. Now, if we look at the next level, and I want to do this real quick, I want to erase this first one because now we're moving away from the day trades. The swing trade level, where I would be semi-interested, is a much firmer level. Notice how the swing trade level goes back further. The further a trend line goes back, the more powerful it is in terms of its support levels. So what we're doing here is we're basically taking this high here, and you could even make a case that it's right in the same range, and we draw that through. And look at how price got above, it came back, then it went up, then it came back, then it finally went on this crazy run. So doesn't it make sense that it wants to eventually come back to that level? So we're talking about, I believe this level's around 134 to 132 on the chart. So a move down to 134 to 132, I might play this as a swing trade. Okay, so again, there's your kind of level to watch for. Now, yes, the chart is decently away, but the way these markets move and the way these semiconductors move, this could be hit in a day or two. It really could if the markets collapse. Like if the Fed crushes the market today, by the way, I'll go into that in just a second on my Fed predictions, but I'm not necessarily in that camp that they're going to totally crush the market today. I think the market's factoring in a very hawkish Fed. I think they'll be hawkish. I'm not sure if they're going to be as hawkish as the market expects. Okay, so there's your AMD level. Now we got to look at Starbucks, guys. Now Starbucks is astounding because like I said, historically you don't see Starbucks move 10% on earnings or greater, and that's where we are right now. Look at the chart; it was just kind of going along the last few days, and then look at the drop that we've seen. If we zoom in on this, you can see a level that I've been watching. It's right below 178. Now again, the fact that we're trading along here, it's not a day tradable level anymore. All right, once you kind of violate it like this, I don't want it anymore. I don't want it, right? It's not that great. So that's the first thing. But either way, it is trying to hold this support level. We'll have to see how it goes. But again, 178, 177, there is a significant amount of support on Starbucks. Going to the daily chart, where are we looking at this daily? And by the way, where is that 177 to 178 level coming from? Look at this. I mean, this is pretty wild. In fact, I have to go to my weekly chart. All right, look at this. So again, the reason why I isolated down that 177 and 178 levels because the trend line goes back to 2009. Now, my only issue here is that the methodology that I teach says that the more times you hit a level, the more you have a potential of breaking down. Well, number one, I mean, how many times did we hit over here, right? I mean, so many times. Then we went away from it, right? And then we came back again, and then we came back again, and then we came back again, and then we came back here, and we're now trading right into it again. And I'm nervous that it's going to break down, to be honest. The way it's acting, the way the negativity is on this could go a little bit lower. Now, where would be the next level? Well, first and foremost, what kind of pattern do you guys see here? Do you guys see a pattern? All right, let's do a little test case. So if you can get this pattern, I give you a gold star. Obviously, I won't know, but if you can get this pattern, then your bonus for you. The pattern here, whoops, there we go. The pattern here is pretty crystal clear. It is a shoulder, head, and shoulder, okay? So we now have a head and shoulders, which is a bearish pattern if it triggers the neckline. Now the neckline, check this out, guys. So where is the neckline? Because the neckline is not this orange line. The neckline needs to go through this COVID low right here and up. So let's do that right now, and let's break it down. So I'm going to erase this first line, and we're going to put in the neckline of the head and shoulders to give us a break point. And there's no doubt it's broken, but look at this. Is this crazy or what? So what you're seeing here is that if you put in your proper neckline, right, and we put that in, you literally get this low here to this low, and you got the exact low going into earnings, which means based on today's gap down, this baby is triggered, and that is not good either. All right, so again, head and shoulders triggered. I could do the measurements, but it would be so nasty that you guys wouldn't even want to know the price target. If this actually did play out, you would take that amount of distance, which is from $125 down to, let's say, $70. So that's a $55 move. And again, take this with a grain of salt. When these targets are so close, number one, we literally, if we go into a depression, yes, this would hit. That's fair. But you would basically take away $50 here, $55 here, and you would take that down, right? And, basically give you a $30, $35 price target on this chart. Now, I don't trade that way because that's a very long-term view. But what I do is I say, okay, well, what could be my secondary level here? And what I would do is as I zoom out, I take a trend line, and we put the trend lines through those same lows. But instead of going through these upper lows, I take it through the COVID low. Now we're talking about a potential swing trade level. Do you guys see that? So now what we're doing is we're taking this low, same low that we started that previous one at, these lows here, right along here, but instead we're connecting it through the absolute low of COVID, and it gives us about a $68 to $69 price target. So there would be a level where I would consider swing trading it. I would also try to find other factors that give me a secondary factor at that level. That always increases your probabilities for success, okay? All right, Pinterest real quick, guys. Pinterest, a nice move on earnings. This was the level yesterday I had on trading the close. I got a short off right up here, and boom, I think I took about, I don't know, $1.50 on it or something like that. It wasn't anything too huge, but on 2,500 shares, it was a nice little payday for me in the after hours there. And again, I wasn't even at my computer. I put that order out ahead of time because, again, it was like, okay, well, if this has the craziest move up, maybe it'll go here, and it did, and then it would pull back, and that's exactly what we got. All right, CVS, guys, getting crushed. And again, you could look at Walgreens, CVS, they're in trouble, right? And this stock, again, is absolutely annihilated in terms of a level real quick here. If we look at this, what are we looking at? I got to zoom out a long way here. I have a couple levels isolated down. We're looking at 56 to 52. 56 is first level, 52 is second level. This pivot low to this pivot low. Those would be my day tradable levels. I'm not interested in, at this point today, on a swing trade. I need to let the dust settle. There's something called a 3-day rule, which is when you have these kind of crazier moves, you don't mess around with it for 3 days because there's going to be margin call selling, institution selling, lots of selling going on that can drive it lower for a few days. I did mention MasterCard just because, again, this one has to do with the consumers. The stock is down on the day, but it is recovering a little bit. It's not down a huge amount, but obviously we are seeing a little bit of a recovery. But any weakness in these stocks, any sort of weakness in the consumer is going to get seen in things like MasterCard, American Express, and these other names. Starbucks, another good one in my opinion, because people are so addicted to their Starbucks. Okay, on that note, guys, what we're going to do, we're going to spin the wheel. Let's do that real quick here. So as we bring it over here, we're going to spin to see what tomorrow's winner will be. And again, folks, as always, what I want you to do is share this stream, this show with your friends, and post it on X, post it on Twitter, Facebook, wherever you want to post it to your friends. That enters you in. Just let us know. And today, look at that, the 1-minute scalpel, Dr. B's course. This is an incredible course, folks. People that have taken this course have said, holy cow, the amount of money I can make now based on using the 1-minute chart and what I'm seeing on the 1-minute chart is incredible. And I myself never traded the 1 minute until Dr. B came in this office and started trading with me, and now I look at it as well. It's that powerful. So congratulations to tomorrow's winner. Don't forget, share this again, and you need to post below so you can be entered. Tell us where you share it, because when we verify that you've won, we're going to go and look and see, did he share it on X? Did she share it on X? Did she share it on Facebook? Whatever it is, we want to see it, and we want to see and make sure that this is getting to as many people as possible. All right, guys, we are going to take a 30-second quick break to thank Lux Algo. They are a sponsor here. I love Lux Algo. I'm working with them on multiple projects, and again, you have to check them out. The link is below in the description. They are rock stars, guys. Seriously, very beneficial if you're a data-driven trader like myself. So take it away.
Have you considered enhancing your trading experience? We have an amazing tool for you. Lux Algo creates next-gen trading indicators to help the world understand the markets in a smarter way. They have the largest user profile on TradingView and are the only official Discord partner in the technical analysis space. Lux Algo Premium operates seamlessly with top platforms, such as TradingView and Discord, making it the perfect tool for every trader. Take your trading analysis to the next level with Lux Algo. Please visit the description below and sign up for Lux Algo today.
All right, guys, we are back here. Now, first of all, we're going to look at Bitcoin. Bitcoin is in free fall, right? We were coming down to that first level, and I gave you guys this game plan perfectly, right? We knew this was good support. We knew this here. It broke. It hit support here. Then it retraced to resistance, then support. As of now, it has broken that key level. So be aware that this has now broken the key level of support, and it's now vulnerable. This chart is vulnerable to going to 53 to 52,000, maybe even as low as 49,000. Now, a couple things that I'm going to watch. So I want to show you this, right? So there's some factor that I'm watching here on the charts. And if we do this and we just kind of do a parallel, and I think I showed you this yesterday, if we take a parallel here to here and we drop it down, you do have a parallel that I'm still focused on. So there is a small amount of hope for Bitcoin. Sorry, I didn't let you guys see that, but there's your parallel. And if by chance Bitcoin can recover and get back above this line here at around 59,000, then you might be able to say, okay, it's holding the downsloping parallel. But again, the vulnerability of Bitcoin is increasing exponentially right now as it's breaking these key levels. And again, by the way, guys, I did cover my Ethereum short today. So again, I have one open position, a Bitcoin short, guys, which we're basically flat on right now. All of my other trades closed out. Incredible gains for members in Smart Money Crypto. So again, congratulations to those of you that are members on the Ethereum win today. And again, I only have one open position now. A lot of people say, oh, there's so many open. No, there's not. There's literally one open position. It's the beauty of it. You can see every other trade I've taken since the start of the service on the track record at verifiedinvesting.com. Verified, baby. All right, so here we have it right here. There's your potential breakdown. Can Bitcoin recover? My guess is if it's going to recover, it's going to be on the Federal Reserve later today. So watching that very closely. Now let's quickly look at Ethereum. Why did Gareth decide to get out today? Why not let this thing go lower? Well, it was a risk-reward assessment, right? So what we see here is that I had two trend lines that were converging and a double bottom. So we have this trend line here, which came across right to here, and we pierced it. And then we had this upsloping trend line from here to here to here and right to here, and it also kissed price here. And so is there a chance that Ethereum can go lower? Like, heck yeah, there is. Heck yeah. But as a trader and an investor, you have to make a determination on what is the chance of you making a lot more money versus what is the chance of you giving up your gains. And for me, at least, I'm generally a little bit more of a conservative investor and trader. I said, you know what? We've had a move down from 3,300 and change down to 2,800 and change, which is where we got out. I took my gains. I said, thank you very much, members. Congratulations on the win. Another win here. Let's move on. Now, if it flushes, now this is the kicker, right? Some people would say, well, if you're out of the short, wouldn't you go long? The answer is no, because I have to be even more secure. I have to be more secure. So now what I'm going to look for is if Ethereum pushes down to this level here, right, somewhere around 2,600, then I might be interested in a long. I will reevaluate in real time for members and guide them, obviously. But there's a place where you cover your short because the risk reward is but at the same time, you're not going long. Like, just because you're covering a short doesn't mean you love it on the long side. It just means the risk reward is now not the greatest to continue to hold that, and you want to pocket some profits. Really important understanding there. All right, guys. Man, I wish I had longer time to go on these. Gold is getting a small bounce. The gold move, honestly, doesn't even matter today, right now, because on the Fed today, that's what's going to matter, 2 o'clock. And by the way, don't forget, guys, I will be live here with Dr. B trading the Fed decision, analyzing the Fed decision, 1:50 p.m. Eastern time today, going into the 2 o'clock announcement. We'll be live for about an hour, so make sure to check back. You can watch it just on the homepage, website, verifiedinvesting.com. Silver, same thing, nothing going on there. Oil's a bigger deal here, guys. Oil may be breaking down. I talked about this yesterday. Again, this was a confirmed support. It got its bounce. Now it looks like it might be violating this level. We need to see if it confirms below. If it confirms below, a failed breakout, watch out below. Failed breakouts. When you have a breakout, like when you go like this and it fails, it's like that oftentimes. So we could be on the verge of a big move down in oil here. I've got to watch very closely. I'll keep you guys updated in the game plan. But this is price action is also, by the way, a little bit of a head and shoulders right here, right? So we have a little bit of a potential head and shoulders as well with a target of $74 down here on the chart. Natural gas real quick, guys. Nat gas, again, really disappointing. Every time it pops up and makes a new high, I mean, at least it's making new highs. But man, oh man, I'll tell you, it's just like pulling teeth to get this thing to have a multiple move to the upside. Now, again, it's still in an upsloping move, but I still think it's got to get there. Yesterday, again, backed off a little bit. Nothing new to report on that. And lastly, coffee, guys. I'll just cover a commodity here today. I have my commodity service, Smart Money Commodities. We cover this almost every day. Major support on coffee here. If it comes back in here, which it should, that's a retrace to the scene of the crime, basically $200. That is a money spot, in my opinion, for a potential long on coffee. All right, guys, I got to get to my trading room. Lots to trade today, but always, guys, it is a pleasure to guide you guys in the action here and get you all set for the trading day. I love your comments. Don't forget to share this to your friends, your family. Post to us where you've shared it. Let us verify. Make sure you get entered in to win the 1-minute scalpel. Thank you again. Watch me at 1:50 p.m. Eastern time today, guys. It's going to be a big event with the Fed. Have a good one. Take care.
All right, traders, good morning, good morning. Happy Hump Day. Happy May. May. Happy May as well. Well, there you go, guys. Markets a little bit of uncertainty here. Job reports came in this morning from the private sector. They're higher than expected. That area still seems strong. Obviously, we had Amazon yesterday. We had AMD, Starbucks. Starbucks is down significantly this morning. So is AMD. Amazon seems to be holding up pretty well. And yeah, we've got, I think we have another data drop at 10 a.m. on the West, 10 a.m. That'll be 7 a.m. on the Pacific, to be specific. And then we have obviously the FOMC today at 1:30. So stay tuned for that. Should be a fun packed day here on the spread. Thank you for tapping in today. Welcome to the show. We got about 4 more minutes until the market opens. We currently have the SPY on the main chart. Excuse me. We still have our daily range 505.31 to the high side, 498 to the low side in the daily range. Pretty tight range when it comes to pre-market low, pre-market high, as well as previous day low. Previous day high is sitting way the hell up there, I think, right? Yeah, I think so. But yeah, so anyways, yeah, way up here. Here's our previous day high. So we're below pre-market. We're pre-market low. So it's over here. So yeah, man, let's get ready to trade here in about 3 minutes or so. Good luck today. And yeah, we'll see you around. I'll have some news to report here, but it won't be for a little while. So let's get ready to trade here for the early morning. Hope you guys had your morning routine ready to rock. I've done my daily devotion this morning as well as my exercise, and already set my charts up and listened to some Garrett Soloway this morning. Obviously, Bitcoin's on free fall as well. If you guys are Bitcoin traders, Bitcoin down pretty big this morning, down to 57,706. Just a couple of days ago, we were talking about $60,000 range. So you guys be careful out there. Trade smart, trade safe. And yeah, thanks for being part of the show. Do not forget to subscribe here on Tradecaster. We're also dual streaming on YouTube today. So do your boy a favor and subscribe on Tradecaster or on YouTube, and get notified for any future shows. But yeah, we're getting ready to trade here in about 2 minutes. Good luck today. Be cautious and stay safe. All right, good traders, good morning. 6:30, market is open. Happy hump day and happy May.
on and just rock. Rock the party. Rock the party. Come on and just rock. Rock the party.
All right, AMD. Here's some AMD info for you. AMD forecast misses by a hair. Hit by weak demand for gaming chips. Still makes sense. COVID upgrades will take a while to refresh, especially in this economy. Q2 revenue, 5.72 billion forecast, came in at 5.7 billion midpoint. A 0.35% miss. Beats and meets, 53% margin, operating margin. So it matched the margin. The operating margin is at 21%. It was a beat. It was up by 1%. Q1 expected earnings per share was 62 versus 61. Q1 revenue 5.5 billion versus 5.45. Down about 6.11% in the after hours. Wall Street AI is extremely hard to please. SMCI supermicrocomputer beats across the board. Q3 adjustment earnings per share 6.65 versus 5.58 estimated. Q4 sales 5.3 billion versus 4.73 billion estimated. And Q4 adjusted EPS 802 versus 6.97. Amazon beats but misses on Q2 guidance. Starbucks first sales drop since 2020. EPS adjusted 68 versus 80%. And then Tesla, odd 500% layoff at supercharger team. Troy Tesla believes that 4680 ramp is too expensive, and the company is cutting costs where they can. Ooh, I partly agree. They're definitely cutting costs everywhere they can, but they seem to be focused on spending 10 billion in AI training, cap expenditure, and cutting from everywhere else to support that. They just don't have the cash Uber Bulls think they do. Q2 Fremont production seems to as continuing to slow, similar to Q1, which is odd since the refresh should be complete. However, the Model 3 did lose its $7,500 tax credit this year, making it the more expensive than the Model Y for the same style. I think it's unlikely Tesla is going to beat 2023 delivery numbers. ECI raised and inflation important items are not favoring the rates. Troy seems a large decline in Chinese deliveries this year as well, now expecting 418,000 deliveries for the quarter versus 479,000 consensus. Elon Musk tweeted, Tesla will spend around $10 billion this year in combined training and inference AI, the latter being primarily the car. Tesla will spend about, This has led some to say, some of the expense will go into the car and therefore show up in cost of goods sold. And Elon is simply adding that together to show how much they're spending. Maybe Elon is considering the cost of computers they're installing in the cars. So assume $2,000 per hardware for computer, 1.8 million. That's 3.6 billion, still over for 6.4 billion in training. And that's assuming Elon is adding up the cost of all the computers they're installing in cars, which seems weird because they do that anyway. So maybe trying to make it seem more impressive. To me, training will be extremely expensive, much more than I previously suspected. Elon's response, Tesla's plans to grow the supercharger network, but at a slower pace for now, new locations and focus on 100% uptime and expansion of the existing locations. End of the month and day prior to Jerome Powell. Today was the end of the month, meaning yesterday, common rebalance day, and then Jerome Powell speaks tomorrow, FOMC, which is today. So FOMC expecting 60% hawkish, 40% dovish. Stable rates, possibly announced reducing treasury runoff to 30 billion, half of the previous month. Likely reiterate peak rate. Hopefully we leave that door open to hike. Wow. Reiterate goal to cut rates this year, but needs more confidence. So far we have not gotten any. Possibly reiterate second half inflation may come in lower, but we'll have to wait until then to see it. This means July, August, September. So basically pushes rate cuts into November, December. Market today is betting on a 1.25 rate cut. Wow. White collar job growth. White collar hiring has stalled in areas like finance, technology, media, and professional services. Zero Hedge is noting. San Francisco, Los Angeles, Chicago have seen a net minus 120,000 white collar jobs, and Phoenix and Seattle seen declines. Miami, Austin flat. White collar jobs up just 0.06 from the year ago in March. Some are seeing low job security in tech, pressure to replace jobs with AI. Lowest job openings in software development, banking, finance, and media. Wow. Well, there you go. That's a little update for you guys. All right, nice bounce here on AMD. It looked like it was going to continue lower, but it's starting to bounce just a tad. SPY kind of just chilling. We probably can't expect much to happen here until FOMC, so it'll be pretty chill, pretty dead. U.S. House Republican Taylor Greene says she will call for vote to oust Speaker Johnson next week. ADP match payrolls change revised from 184 to 208. ADP non-farm employment changed from April from 192 to 179 expected, once the 84 prior. Major Asia and Europe markets closed for Labor Day. Oh yeah, well, that's not for a while. What the hell? All right, just reading the news here, guys.
Dark wave. Break it down. Dark wave. Break it down. Dark wave. Dark wave. Break it down. Dark wave. Break it down. Dark wave.
All right, Bitcoin 57,500, 57,500. Can't believe I've been saying 60-some thousand earlier this week. S&P down, S&P 500 down $10.06, 0.20%. VIX has popped up a little bit up to 16. You know about Bitcoin. Oil seems to be getting ready to sell off. Oil is currently at 80.87, really forming a just seems to be breaking down. So hopefully things chill out in the Middle East, and we'll be good. Yeah, but Bitcoin's 57,639 currently. And then AMD is getting a nice little pop here. AMD up, is still down almost 5%, 4.5% here from the earnings last night, but it's recovering nicely. Looks like it barely missed, and it gave a good guidance. So we'll see how that goes. All right, traders, wherever you are, wherever you may be, happy hump day. Happy May. It's FOMC day today, about 1:30. We should be hearing from the feds. And yeah, we'll be streaming that live and watching the market react together. You don't have to do it by yourself. You don't have to do it by yourself. You can do it here with me and everybody else. So come back around that time, and then we'll be broadcasting live and watching the market react. Not sure if we're going to be trading anything today. If you've been hanging out with me throughout the week and all of last month, thankfully for me, my business is getting more and more busy. So it's requiring me to focus on that. and not focus on trading at the moment. So, but we are streaming live. We are here 30 minutes before market open until market close. We'll stream earning calls. Sometimes we'll hang around for, major announcements. But we appreciate you being here. Don't forget to subscribe to the show here on Tradecaster. We're also dual streaming on YouTube. Do not be afraid to chat and participate. Let us know where in the world are you? And just love to know who you are and what you're doing and what you're about. And yeah, thanks for spending a little bit of your day here with us today.
Dark wave. Break it down. Dark wave. Break it down. Dark wave. Dark wave. Break it down. Dark wave. Break it down. Dark wave. wave. Break it down. Dark wave. Break it down. Dark wave. Dark wave. Break it down. Dark wave. Break it down. Dark wave.
All right, traders. Welcome to The Spread. I'm Shimano Trader. Follow me on Instagram. Thanks for tuning in today on The Spread. We are a live trading show 5 days a week, 30 minutes before market opens. We are currently watching the SPY. We're obviously trading in a little bit of a range here. We got FOMC minutes coming up in a couple hours. Market's pretty down, right? What do we got? Minus 8.81 on the S&P. Everything just kind of chilling here, waiting for the meeting to start. So we'll be streaming that live for you guys. So we'll be able to hold on. Yeah, we should be able to take that on. We'll be streaming the FOMC meeting and watching live action and reaction to the market as the news gets released. So stay tuned. If you're just hanging out with us for a little bit, then make sure you come back. Don't forget, we got other streamers in the lobby today. Obviously, we got Sean here, AK47, J Trades, Futures Trading, Liquid Vision, and Policing Peeps still in the house. Make sure you stop by and show them some love. Thanks for stopping by here on Tradecaster. Thanks for stopping by and saying hello to May. Yo, don't forget, if you're in the chat, let us know where in the world are you? Where in the world are you joining us from? Let us know what you're trading. How are you positioned going into FOMC? Are you sitting on your hands? Are you sitting on the sidelines? Do you have cash deployed in any other asset? As you guys know, Bitcoin is selling off pretty hard today as well. Bitcoin down to 57,356. Ethereum is currently sitting at 2,900 even. So yeah, things are looking a little weak in the crypto market. It has been looking that way for a couple of weeks now. So be careful, trade with caution out there. Enjoy the show, listen to the jams. Thanks for being here with me today. If you have any questions, I'll be commentating here, but I am just kind of working on some of the things here as we are watching the market. So yeah, thanks for being here. If you have any questions, let me know. And yeah, good luck today.
they never thought they could.
Equities. Goldman's Peter Oppenheimer helps answer that question today.
Then, has Europe achieved a soft landing? Harris Associates' David Harrow joins us with his top picks overseas.
Starbucks' worst day in more than 4 years. Why the street is punishing that stock, down some 17%. Right now, markets, though, are trying to hang on to levels above, say, 5K by about 26 points. Dow's benefiting from Amazon, upgrade of 3M, but it has been a tumultuous couple of days as the mix between the earnings and the macro weigh on some stocks. Let's bring in our senior markets commentator, Mike Santoli, and talk more about the Fed, which is a couple hours away now.
Yeah, to me, all about how the bond market absorbs whatever Powell has to say here. Our yield's looking a little bit fatigued up here. We got a little bit of relief from that Treasury announcement this morning. When it comes to Powell, I mean, you guys have been talking about it. I don't think he's going to rush to that point of trying to acknowledge that maybe, a hike is on the table. I don't really think it is. They're still in this mode of most of the data have kind of stalled a little bit, but not really veered away from them at this point in terms of disinflation, allowing for a window to cut. When you have that as the backdrop, to me, it's all about the market figuring out, okay, the last time or the first time we were at these levels, what were the assumptions? What's changed since then? I'm big on this. 50-50 on the S&P. We first got there February 12th of this year. We closed in the 50-20s. That's where we are right now. What was the next day? It was the January CPI report. The January CPI report was the first hot one. And so it's kind of like that was the moment when you felt as if you didn't have to worry so much about the inflation side of it. But also you've been talking about all the anecdotal buildup of the consumer companies talking about softening. It's Fed friendly. Oil's down 6% in less than a month. That's Fed friendly. All these things that the labor market numbers also coming off the boil, right? So it's not as if it's been this one-way trade. It feels like the chatter has gotten very hawked up into Powell.
Yeah, on the inflation numbers, not as much as, to your point, we got a 1.6% GDP number.
Right.
We had to have some weakness. Look, we played some earnings calls earlier, weakening consumer and increasing warnings of that from Starbucks to McDonald's to Yum Brand and outside of the restaurant sector as well. I feel like the most hawkish thing he could do, and this Steve Englander wrote about this of Standard Chartered this morning, is sound agnostic about which way the next rate will move.
Yes.
In other words, they've had this easing bias. The next move is going to be a cut. If he walks that back too much and says, well, we could cut, we could hike, we have options on the table, that would be hawkish.
It would be hawkish, and I think maybe because it would implicitly mean that Powell's rethinking his stance that the economy doesn't necessarily have to slow very much in order for inflation to come into line. Remember, that was the magic of the December pivot.
I'm not sure they're convinced of that yet.
No, I don't think anybody's fully convinced of that. We don't know if the services sector really has to slow a lot more to get prices down, or if they even are going to insist on that. That's the other part of it, too. You can massage the inflation numbers to some degree. By the way, a soft stock market in the second quarter is going to directly pull down PCE inflation because the financial services.
We talked about this yesterday.
It's just one of these things where you can kind of allow the pendulum to swing a little bit in that direction and say, okay, we're not that far out of the zone of where we thought we were going to be.
Mike, we'll talk in a bit. Mike Santoli, thanks. As we said, a few hours away now from the Fed chair's remarks. Our next guest is keeping an eye on the correlation between fixed income and equities, a relationship he calls complex and unstable. Says if the 10-year goes to 5, it has historically been a bad sign for stocks. Peter Oppenheimer, Chief Global Equity Strategist for Goldman, joins us. Peter, thanks for the time today. Good to see you.
Thank you. Good to be here.
How destructive would 5 be?
Look, I think based on history, and of course there are lots of factors that may impact this, I think 5 would be a problem. What we're seeing at the margin is, of course, interest rate, hopes for interest rate cuts being pushed out, but also slightly weaker growth. And, normally at around 4.75% to 5%, a rise in yields above that tends to be a problem for equities. Now, the speed of the change is really important. We find that, particularly in real terms, if you get a move of more than 2 standard deviations in a month, stocks are usually off around 4 or 5%. that equates to a 2 standard deviation move is around 50, 55 basis points at the moment. So the speed is really important. The level is important. But we also got to take into account that stock valuations are pretty high and risk premia are pretty low. So I think we are vulnerable to a rise in bond yields from here.
What about the argument, though, that robust yields are a function of a strong economy, especially at a time where some Q2 trackers have 3s in front of them?
No, look, absolutely. And this has been very much our view that we've got an economy, certainly in the US, growing at around 3% this year. So unless you get a recession, we think that's very unlikely, profits are still going to grow. And ultimately, equities are a play on growth and on nominal growth. And, you know, I think that a setback is perfectly plausible, but we're not talking about anything that's very significant as a risk on the downside, while you've got rising real incomes and a strong labour market, a pretty robust growth, and indeed outside of the US, an improvement in activity beginning to come through. So I think it's a real balance here. What I would also say, and I think it's an important point to make, is that the composition of equities has changed quite a lot. You know, we've seen a lot of focus on the concentration of the super large stocks in the market. This has been true in many markets, particularly in the US. And these dominant companies also have net cash or very strong balance sheets, and therefore they're relatively immune, at least, to rising interest rates, which makes the index less sensitive than it's perhaps been in the past.
There's also debates right now between value versus growth and, you know, big mega cap tech stocks versus broadening of the market and cyclical versus defensive. Where do you want to be right now?
Well, the view that we've had for some time is to have a kind of barbell between what we would call quality growth, so these strong balance sheet growth companies that are less sensitive to rising rates than pure long duration growth. And then alongside that, have exposure to deep value, because what we're finding is that there's some very cheap parts of the markets in value sectors which have been neglected for a very long time, but where you're starting to see some really strong compound cash returns for investors. And this is true in a number of areas, including energy, in banks, for example, particularly in Europe, where the bank sector has been a serial underperformer for a decade or so, but has started to perform pretty well because these companies are paying dividends, buying back stock, and are very cheap. And that's a good sort of balance and hedge against the risk exposed to rising rates for equities more broadly.
You're a global equity strategist. Do you see the best opportunities in the U.S. equity market, or better go elsewhere?
Well, again, I think the key here is one of diversification. You know, the US equity market has become hugely dominant in the global index for good reason. It's seen much better profit growth over the last decade relative to other markets. But we think that investors should be broadening out and looking at opportunities outside of the US. That doesn't mean to be underweight of the US, but to have more broad global exposure, because some of the more value-orientated markets like Europe, like Japan, are actually holding up or even outperforming relative to the US, because they're a lot cheaper and therefore less exposed to the risks of rising rates. So, you know, we have a bit of a balance globally, and think that really investors have got to focus on alpha, really good opportunities, irrespective of the location of the actual companies themselves. So maybe, you know, from a US perspective, that does mean that the opportunity set for broadening out in other markets is increasing.
It has been interesting to watch sentiment shift a bit, especially US vis-a-vis Europe. Peter, pretty fascinating. We'll know a little bit more in a few hours. Thanks so much.
Thank you.
Let's get to the earnings mover of the morning. Starbucks shares getting crushed today, with the stock now on pace for its worst day, I think, since 2020. This is Starbucks' biggest earnings miss ever and the second straight one, something that hasn't happened since the financial crisis. Big declines in traffic, the chief catalyst this quarter, with comps falling 11% in China, 4% globally. North America's same-store sales also dropping 3%. Here's Starbucks CEO Lakshman Narasimhan on the slowdown.
If I look at the U.S. occasional customer, they have clearly cut back on visits to us. If you look at the value for money scores we have, they're still strong. but there's no question that the occasional customer is cutting back on visits to us. We have not been able to communicate to them the value that we provide.
Most firms cutting their price targets on the stock today. William Blair and Deutsche Bank actually going further and downgrading the stock. B of A this morning in its consumer notes saying at a loss for words on the quarter. Jim Cramer also pretty scathing on the stock, having recommended it for the investing club. Carl, the biggest concern seems to be why? The unexplained weakness. I know there were things blamed like the macro environment, the pressure on the consumer and inflation, high prices of the Starbucks drink, long wait times maybe. I don't know. Did you get a better sense in interviewing the CEO of why this sharp drop in traffic, down more than 7%?
I mean, you can throw a host of theories at it, whether that's a cracking consumer or Middle East tensions, obvious China weakness. Jim really did hammer him, though, on the throughput and the mobile order disruption of making an order on mobile, getting there, not being able to get because it's not ready. Certainly we've been watching the 5-year chart down now, negative over 5 years, whereas the S&P's up 70 in 5 years.
So it's been kind of a long-running story, but the thread here in some of these notes is that it's hard to find visibility as to when it will turn around, if it will turn around, that they have a good handle on it, that management is doing the right things, and that, to Jim's last question, there's a reason to be buying the stock into the next quarter. Starbucks shares down 17%. Still to come. Has Europe achieved a soft landing? We're going to find out. Talk with one fund manager who lays out his top international picks. Heavy exposure in Europe.
Pins is a rare success story today, raising their Q2 guide, expecting margin expansions for the full year. Analyst points to AI investments as a tailwind as well. Stock's having its best day since October of 2020. Money Movers back after this. Keeping an eye on CVS today, the company posts a revenue and EPS miss while also slashing its full-year profit outlooks as the new outlook assumes that its high medical costs and its insurance business will persist throughout the year. Owns health insurer Aetna. Stocks down 31% year to date. Obviously, the cost ratio was painful, but even front of the store comps down 2% as the retail experience has withered, in some opinion.
Yeah, the things they've had to do to lock up some things, and also the softness of the consumer. Just another example of how these top and bottom line misses are getting doubly punished in the market with double-digit declines like we're seeing with Starbucks and CVS. Turning to the market abroad, the latest data out of Europe showing inflation held steady in April while GDP rose in the first quarter of the year. So, did Europe stick the soft landing? Joining us now is Harris Associate CIO of International Equities, Portfolio Manager David Harrow. We always turn to you on Europe because you've had some of these banks and other names there for a long time. Did they get it right in terms of the inflation coming back down without going into recession? Or is it too soon to say that?
Well, it is looking a lot better. The macro conditions in Europe are looking a lot better, which is very conducive, of course, to earnings growth. You know, our focus at Harris Oakmark is really on company-specific factors to find quality businesses that for some reason are selling at discounted prices. And these macroeconomic disturbances that we've seen have really opened up a lot of opportunity in the greater Europe area, especially given so many of these European-based companies, of course, do business all over the world. But the market was really focusing on the shallowness of the growth in Europe and the war in Europe. And now what we're starting to see is some of what the market was focusing on, which were headwinds, are now turning into tailwinds in terms of sentiment. So the companies have always been doing well, but investment sentiment has been bad because of this belief that Europe was such a laggard in growth and wasn't going to bring inflation down. But as you mentioned, we're starting to see a turnaround here.
I do wonder, though, how much you have to battle just the flows. There's just been so much interest, and we hear it all the time from portfolio managers in the U.S. Go to where the growth is. The AI plays, that everyone wants to bet on AI right now. That's in the U.S. It's not over in Europe. The fiscal stimulus and some of the changes we've seen in terms of this economy. How much do you just have to fight that when it comes to the underperformance of these European names?
You're right. This is a fight we have to engage in, because ultimately, what doesn't make a company valuable, what doesn't make an investment valuable, is not a story. And if it is a story, it's how that story relates to that company's ability to create and grow a cash flow stream. And investors like to get caught up on themes and stories and whispers, and they don't ultimately come to grips with what makes an investment successful. And that is buying at a reasonable or low price a good quality business that generates a good cash flow stream. Because investors are so focused on what we believe are non-fundamental factors, it gives investors such as ourselves at Harris Oakmark an opportunity to exploit what I would call an inefficiency. You're exactly right. I've been doing this since 1986. And I've had to, in the beginning of my career, justify why international, why now? And we're actually hearing the same thing today from across from broad voices. Why should we invest in international? And I think, of course, the number one reason is, why would you limit yourself to one narrow market? The U.S. is roughly 25% of global GDP, but of the world index, it's over 70%. So as you were saying, the weight of money's just flooded in. Now, as an investor, you should be thinking, not what's happened in the past, but where's that weight of money going in the future? And I think ultimately, the fundamentals, and again, what makes a company valuable is its cash flow stream, and the ability for an investor to buy it at a low price is how you succeed in investing. And I think if you do broaden your worldview, whether it be in the lower quartile stocks in the S&P 500 or looking overseas, this is where future opportunity will be. If you get obsessed with the rearview mirror, I think you're going to get caught in some nasty moments.
Although, to Sarah's point, I mean, there's stories on the tape today, David, about European energy giants looking to list in New York over London. Flutter, for example, making New York its primary listing, perhaps. I mean, they see the writing on the wall, too.
Well, either that or it's bottom speak, because, you know, it's like the Business Week or Forbes cover stories. And is this an indication that we've almost hit a point of maximum pessimism? I would argue that it's more that. And, you know, I don't really blame them for thinking it. If you can get a valuation 30 or 40 or 50% higher, certainly you should consider it. But at some point, I believe there will be a leveling out of these valuations just because the fundamentals are primed for it. Let's get back to the basics of investing. Ultimately, you want to buy a stream of cash flow at the lowest price possible. And in the short term, you know, you often are given all kinds of head fakes by paying a high price for a skinny cash flow stream. That's going to catch up. It always does. It always does. I don't believe it might take a while. And this international underperforming the U.S. now has been almost 12 years, basically. But there have been long periods of time where international has outperformed. Same thing with value over growth. It always catches up. Sometimes it takes longer, but usually the bigger that gap is, the sharper the snapback is. So I'm fully confident that we will see this.
All right. Very consistent message, David. Thank you for joining us on the Case for Europe. David Harrow from Harris Associates.
Thank you.
Carl, case in point, Viking Cruises going public here at the New York Stock Exchange today. Biggest IPO of the year. Where's the headquarters? In Basel, Switzerland.
I hadn't thought about that. We are getting a news alert out of Washington today as the CEO of United Health testifies in front of lawmakers following that massive data breach. Let's get to Emily Wilkins. Hey, Emily.
Hey, Carl. Well, yes, just wrapped up a contentious hearing where United Health CEO Andrew Whitty was really grilled by a number of lawmakers over a variety of different things, both the national security concerns, as well as when his company is going to make some of these doctors whole. And this was a question that we heard again and again and again. When are they going to notify people whose data has been breached? When are they going to make these doctors and physicians who are now having to reach into their own pockets to cover costs full? And at this point, there weren't any specific clear timelines. Often, Whitty kind of struggled to be able to say when this was going to happen. At one point, he said several more weeks, and another senator said, you've been saying that now for more than 2 months. He did at the end suggest that they would be able to make doctors and physicians whole in the next month to 6 weeks. But there are also more concerns, and the chair, Ron Wyden, suggested there could be more investigation into United Health, to its size, and whether some antitrust protections are needed here. Guys?
Emily, thank you. We'll watch that. Shares obviously responding a little bit positively today in what's a mixtape. When we come back, some more details about layoffs at Tesla. The stock giving back some of Monday's 15% plus gain.
Then at least 14% price target hikes for Amazon and counting this morning, including Citigroup, who's going to $245 a share, calling the company a structurally more profitable business. Stock is lost some of its early gains, but it's still up 1.5%. We'll be right back. Welcome back. New data showing spring auto sales are off to a strong start. Meanwhile, getting some new details about layoffs at Tesla. Phil LeBeau covering both stories for us this morning. Phil?
Sarah, let's start first off with April auto sales. Now, we're getting the foreign automakers today. We don't hear from GM and Tesla, Stellantis, but we do hear from the likes of Toyota, starting off with another strong month. April sales for Toyota up 13.7%. Hybrid sales up 49% year over year. They're continuing to kill it when it comes to hybrids. As for Hyundai, April U.S. sales down 3%. They do note that there were too fewer selling days in the month of April, so that impacted total volume there. Meanwhile, when you look at the overall demand that is out there, we have a chance. I don't think it's going to happen. We have a chance to get to 16 million as a sales pace for the month of April. Compare that with where we were at 15.4, 15.3 the last few months. Hybrids, as I mentioned, with Toyota remaining strong. Average auto loan rate continues to hover above 7%, but that has not slowed down the demand that is out there. Now let's shift gears and talk about Tesla. The news that came out late yesterday, or yesterday morning, I should say, regarding Tesla letting go of basically the entire division when it comes to the supercharger. Elon Musk clarifying on X, saying Tesla still plans to grow the supercharger network, just at a slower pace, with new locations and more focus on 100% uptime and the expansion of existing locations. Raises the question, where are the existing locations? How many are there? Tesla doesn't break it down by region, but worldwide they have more than 6,200 stations and more than 57,000 connectors. Most believe it's about 2,000 to 2,500 in terms of supercharger stations here in the United States. As you take a look at shares of Tesla, remember, they're in the midst of cutting more than 10% of the staff. That was announced a couple of weeks ago, and at the time, Elon Musk, according to reports, wanted to go even further. He wanted the cuts to be closer to 20%. And then you had the news that came out just a couple of days ago that they are going to be essentially letting go of the entire supercharger division. Doesn't mean they're shutting down the supercharger network. You're going to still see them working on it. Remember, they've got federal money, guys, that they're receiving as part of their expansion of that supercharger network. So it just remains to be seen how it will be staffed and in what fashion going forward.
Pretty fascinating, even with some more headlines hitting the wire right now. Phil, thanks. Phil LeBeau. For more on demand in the auto market and what's next for Tesla, let's bring in former Ford CEO and CNBC contributor Mark Fields. Mark, it's good to have you. We got a flash head right now from, I think, Bloomberg saying that Tesla retreats from next-gen gigacasting manufacturing process, according to sources. What are investors supposed to make of some of these headlines?
Well, you know, I think if you're inside Tesla right now, there's probably a lot of confusion. You know, if you're an investor, you know, you're looking at the business right now and you're saying, listen, the last quarter, it burned cash. At the same time, you know, you got lots of management turmoil. You got market share going down. You have more inventory than you ever held. And you're having all these kind of announcements that come out a bit haphazardly of what they're doing with costs, et cetera. So it's got to give them pause in terms of, you know, their investment, what the strategy is for Tesla going forward. But also, Carl, if you're inside Tesla as an employee, you know, you've got to be looking over your shoulder, because when you do these kind of reductions in workforce, usually what you want to do is you want to say, here's the percent we're cutting. Here's the date by which we'll be done with this, at least for now. And Tesla has not kind of articulated that. So it's a little bit of a drip by drip. And what you'll see inside Tesla's organization probably is a lot of paralysis right now.
Do you believe that less commitment to the charging network hastens a broader slowdown in EVs, like lowers the adoption curve even more?
Well, from a consumer standpoint, it's not a positive news, right? Because if you're a current Tesla customer, you know, when Musk says, listen, we're going to increase the uptime of our locations, you know, that translates into the customer saying, I'm going to have to wait more. I'm going to have more cars in front of me because he wants 100% uptime. If you're a customer considering a Tesla, you're saying, well, okay, it might be more inconvenient for me to charge this vehicle. And importantly, if you're a customer of any of the other OEMs that have signed up to use the Tesla network, it's just not, it's a net negative in terms of from a consumer standpoint. So it doesn't help, but overall, over time, you know, the adoption of EVs will increase over time, but it's going to be slower than everybody expected, and that's why you're seeing all these announcements of pushbacks of product. and facilities. But this latest announcement, overall, Carl, it's a net negative.
Putting all the announcement in context and talking about the sort of cultural issue that you see over there at Tesla, Mark, is it an opportunity for some of the competitors like GM and Ford that have been trying to catch up on EVs, or is it more bad news for them too?
Well, Sarah, it's a great question. Like I said, from an overall market standpoint, it just basically says, listen, from a consumer standpoint, we'll wait until you guys all figure this out before we consider an EV. But if you're a GM, a Ford, or one of the other automakers, there is opportunity right now, because at least if you piece together the announcements that Tesla has made or has leaked around their product plans, it just sounds like there's a lot of confusion there right now. And, what Carl mentioned about the gigacasting pushed back, you recall from Tesla's Investor Day a year ago, they said that was absolutely crucial to bring down the cost of their vehicles and also bringing out this sub $25,000 vehicle. So, if you're one of the other automakers, you're saying this is an opportunity for us to catch up as you see the turmoil in Tesla. And I think the launch of the GM Chevy Equinox, which is coming in the next number of months, that's priced right in the heart of the market. So I think that'll be a real touchstone for the industry to see if they can take the cost issue off the table for consumers.
That's a good point. We talk so much about the industry slowdown. We haven't mentioned that there's still a lot of new product on its way. Mark, thanks. Good to chat. Appreciate it.
All right. Thanks.
Time now for a news update. Silvana Hanau has that for us. Morning, Silvana.
Hey, Sarah. Good morning to you. Well, a major shift is coming to the United Methodist Church. Following decades of controversy, church delegates voted 692 to 51 to repeal a long-standing ban on LGBTQ clergy today with no debate. The rule prevented people in the community from being ordained or appointed as ministers. The measure will take effect on Friday. The House will vote today on an anti-Semitism bill as pro-Palestine protests cause chaos at colleges across the U.S. The measure would mandate the Education Department adopt a broad definition of anti-Semitism used by the International Holocaust Remembrance Alliance. House Minority Leader Hakeem Jeffries is pushing for a vote on a different bill that would appoint an advisor to the president on policies to address anti-Semitism. And the Biden administration canceled $6.1 billion in student loans today for 317,000 former students of the Art Institutes. The Art Institutes were a for-profit group of colleges that closed after being accused of widespread fraud. Carl, I'll send it back to you.
Silvana, thanks. We are still awaiting the first trade for Viking Cruises. Biggest IPO of the year. Prices at 24, indicated 26 to 28. We'll get you over to Post 5 after a break. Awaiting Vikings first trade, indicated range just moved a bit higher. Let's get to Bob Pisani. Bob?
In fact, just moved up $1, but still $2 range here. We are waiting for that, and of course we have indications earlier, 26 to 28, just upped it to 27 to 29. Let's talk to the guy in charge down here. Pete Giacchi is the head of DMMs for Citadel Securities. How are we looking here? You just changed the indications.
Yeah, we're seeing strong demand, and it's great to see the largest capital raise of the year here today, you know, especially on the heels of Rubrik's recent IPO. We started off at 26.28. We've moved it to 27.29. As you know, this is an iterative process where we're building both buyers and sellers. It's going to play out over the next couple hours. We'll obviously be tightening this range as the book continues to build.
So it's amazing how this was upsized. 44 million, I think, initially, then 53 million, now 64 million. That's a 50% raise, $1.5 billion.
Yeah, like I said, it's really great to see it. It's great to see that it is the largest capital raise of the year here. It's great to see that there's demand for it, and especially on the heels of recent IPOs that we've had here, like Rubrik's strong performance.
27 to 29, so it's a $2 spread. Normally that spread will narrow before we go. When are we going to see that narrow?
Sure, it'll definitely narrow over time. You're going to see a few more indications before we get ready to open. My guess is this will probably play out over the next hour or two as we get ready to open, and you'll see those indications tighten over that time frame. Ultimately, we'd like to see it get to maybe a 50-cent range prior to opening.
We've got a whole bunch of other consumer names out there. Panera Bread is waiting to go public. There's Liquid Death. There's other kinds of consumer names. Is this an indication? This generally could be considered a consumer name.
Yeah, I think, like I said, Bob, when you could come to the market and raise $1.5 billion, there's obviously appetite for IPOs out there. And like I said, it's strong to see that. So I do think that we're starting to see the IPO market thaw, and we're seeing some green shoots in the market for sure.
Okay, Pete Giacchi will be here watching this. I just want to point out to everyone, this is the biggest IPO of the year, $1.5 billion. We have, about $5.3 billion raised in April. That's the biggest month for IPOs since November of 2021. So a lot of hopeful green shoots here, despite the fact that we've had a rather poor market in September. Now, you'd think cruise lines would be very happy about all this because the good numbers here. Look at what's going on in Norwegian, though. Down 12%. It's one of the big decliners here. Now, they had good numbers here. Demand is strong. Their earnings, record bookings, prices were increasing. But the revenues were a little bit light. Now, this seems like a fairly small matter to me, but that's the only thing that I could actually see that was anyone would nitpick about the report about. So this is an indication that there's a lot of speculative interest in there that may have been pulling out and putting some money into Viking at this point. So the big debate this afternoon is about the Federal Reserve and what goes on here. Are we dealing with some issues here with the big threat to stocks is higher for longer interest rates and disinflation not going down enough? Or is the bigger threat some kind of slowdown in growth? You've been talking about, guys, Starbucks, McDonald's, some of the middle to lower end consumer stuff seems to be a little bit weaker, but we have a fairly broad economy and a lot of the spending is done on the higher end, you know, so 40% of the consumers out there spend the vast majority of all the money. So the higher end seems to be doing well. We had great comments from Marriott today with revenue growth strong. Caesars says the consumer remains healthy. Here's MasterCard, which is down a little bit today, but they had talked about healthy consumer spending. So I think, guys, there's a very clear bifurcation going on here between the middle lower end consumer and the upper end consumer, which is the one that does most of the money, indicating that they're still holding on pretty well. Guys, back to you.
Yep. All right. Big story for us. Thank you, Bob. Bob Pisani. Let's get a market flash now on MasterCard, which Bob just mentioned. Kate Rooney just off the phone with the CFO on the back of earnings. Shares are under pressure, Kate. What did he say?
Yeah, Zara, so just spoke to MasterCard CFO Sachin Mehra. He called the consumer healthy. That is the headline. It really comes after Visa's CEO last week called the consumer stable. So more commentary like you guys have been talking about. He talked about the lower guidance that had hit the stock. It does seem to be weighing on shares a bit. Said that is fully the result of FX headwinds. He said they wanted to be transparent about it. It does not reflect any sort of confidence in the consumer. He said they actually are feeling good about spending, called it restaurant spending, said consumers are really leaning towards travel and experiences and some of the services, is seeing that reflected in cross-border volume, which was strong for the quarter. He said he's seen broad-based strength of the consumer that is driven largely by record low unemployment, rising wage growth as well. He did say he has seen a decent amount of stability in terms of both the affluent market, what you kind of hear from American Express, and then the mass market. He said both are holding up nicely in the U.S. and the rest of the world, but more commentary on the consumer, Sarah, and it's looking good from MasterCard's perspective. Back over to you.
Yeah, from MasterCard's perspective is the key there today with all the different comments we're getting across the board. Thank you, Kate Rooney. HSBC's U.S. economist Ryan Wing with us next. His outlook for the Fed and the risks of pushing back those rate cuts. Stay with us. What should you be listening for during today's Fed news conference? Our next guest expects the FOMC to say that it will slow the pace of quantitative tightening, still predicts 75 basis points of easing this year, starting in June. Let's bring in HSBC U.S. economist Ryan Wing. Really, in June? So you think they're going to be cutting at the next meeting? All the evidence and Fed speak has pointed to that not happening.
Well, that's true. This view that we've retained it since the beginning of this year. So admittedly, what we've been forecasting is a gradual 25 basis points per quarter rate cut path. And we've had that commencing in the middle of the year. Now, what I think is really important is you have to think about what is the reason for reducing policy rates. Is it just because inflation has fallen over the past year? For example, that core PC inflation measure the Fed loves to monitor very closely is a bit below 3%. that can get you some rate cuts, but they're more likely to be of the slower and the later variety. Whereas to get kind of the bigger rate cuts, the faster rate cuts, that's going to require, I think, more significant weakness in the economic data. And so if you really look at it since the start of the year, arguably the biggest surprise has been the resilience of the overall U.S. economy.
And the stickiness of inflation that goes along with that. And the last thing Powell said, in April, was that he's going to need to see more evidence before they start getting on with rate cuts.
Yeah, that's right. And I mean, even if you look at this morning's economic data, it raises a lot of questions. So, for example, we had that March job openings and labor turnover survey. The number of job openings is still very, very high, but it's actually the lowest it's been in several years. And that actually raises some questions about what actually is happening. I mean, on the one hand, it could be that businesses are closer to filling their open positions. They're starting to have a little bit less demand for labor. But also, we know there's been a big boost to labor supply at the same time. So that makes it a little bit tricky, because if you look at most of the economic data since the start of this year, including the most recent set of GDP numbers through the first quarter, generally they've shown resilience. And so they've not really given the Fed much reason to consider rate cuts for growth, from a growth perspective, growth rationale. Some of the recent numbers might be starting to raise those questions once again. Again, you can look to yesterday's consumer confidence report, or also you can look to the ISM manufacturing survey released earlier this morning, where businesses, really, they're all over the map. Some of them are saying that sales are strong, steady new orders coming through. Other manufacturers are saying that orders are starting to weaken, that sales are becoming much more volatile. And so maybe we will start to see more mixed growth data over the next several months.
But I'm glad you mentioned JOLTS. I mean, when people are now looking at the higher rate at multi-year lows, matching the post-pandemic levels, the quit rate obviously going back several years as well, you don't think that sets the table for a wave of layoffs where the labor market really does crack?
Well, I think up until this point, really what we've been seeing is that hiring is slowing, but there hasn't been a wave of layoffs. That's exactly right. And in a way, that does make intuitive sense. If businesses have been trying to hire so aggressively for the last few years, there's really no reason to engage in layoffs. But it is true, as those positions are increasingly filled, as that hiring slows, the next question is, well, have I properly judged underlying demand? Is my workforce properly sized for the sales that I'm going to see over the medium-term horizon? That's the big issue always with sort of unexpected economic slowdowns or recessions that can come. It comes when businesses have sort of misjudged the future level of demand.
And really quickly, because I know you pointed out in your note, I think it's important to mention that the market is expecting a change on QT, the quantitative tightening, and how they've been shrinking their balance sheet. So what would be a surprise today, if anything, on that front?
Yeah, well, I mean, number one, I think it is somewhat separate from this policy discussion about how the economy is doing. But yes, it does seem like the FOMC is very close to a decision on reducing that pace of so-called quantitative tightening. For all-in numbers, we think from roughly $80 billion per month down to about $50 billion per month following the announcement that we expect today. If it doesn't come today, then I still think it's likely to come at one of the subsequent policy meetings, probably in June or July. Now, what's important to note is that this is not a decision to end quantitative tightening. It's just a decision to slow down the pace. It's really slowing down the vehicle, if you like, from 80 miles per hour to 50 miles per hour. So I wouldn't read too much into this single decision, but for technical reasons, the Fed has decided, I think, that they don't want to be going as fast as they have been on this balance sheet runoff, or quantitative tightening, as we like to call it.
Yeah. Ryan, thank you very much for being here, helping us pregame the big announcement this afternoon. Ryan Wang.
Thanks so much.
Coming up next, a look at the continued volatility in shares of DJT. Tech Check will dig into just how much it's cost the shorts as the stock has surged recently. Stay with us. Shares of Trump Media are lower today. The Truth Social app owner opening above the $50 share level, but now falling almost 6%. Our Deirdre Bose is taking a closer look at the stock in today's Tech Check. Morning, Dee.
Hey, Carl, as volatile as ever, even making back some of that ground, but that nearly 6% drop today, it's minor relative to how much ground shares have made back since it closed below $23 a share around mid-April. Now, part of that rebound may have to do with the company's own crusade against short sellers. It's, of course, blaming them for the drop in its stock price from nearly $80 a share and telling its retail investor base how to recall shares from short sellers or make them unavailable. Now, telling them that they can recall their shares and essentially make them unavailable by holding them in a cash account and opting out of any securities lending programs. Earlier this week, DJT issued another press release giving investors an actual template that they can send to their broker asking to not only opt out of any lending programs, but adding this line, as applicable, please recall any shares that are currently on loan. Now, I know you guys have been closely tracking the back and forth, explosive, highly entertaining letters between DJT and shorts like Citadel Securities. So I wanted to put some numbers behind this battle today. Now, DJT should come as no surprise, by far the most expensive short on the street. This is how it compares to some of the other popular shorts at the start of April, Canopy, Beyond Meat, Nikolai, Lucid, just to name a few others. The fee to short DJT is nearly 3 times more expensive than the next most expensive short. Since then, the cost to short has gone up. Short interest as a percent of its float has decreased. So that potentially suggests that DJT's crusade is working and taking supply off the market. I got updated numbers from S3 Partners this morning. The fee to settle new short selling has spiked to between 600 and 650%, and the short interest has slowed to below 9% of its float. Partner Ihor Dusanuski told me that at this point, if the stock doesn't just crash, it's very hard for short sellers to make any money because your financing expenses are eating up most of the profits. But he also warned against attributing the rising fee to retail investors who typically don't lend stock in the first place. And guys, I do have a number for you too. Short sellers are now down on the year with about more than $100 million in losses. Mark-to-market losses, that's down about 80% for the year. But they have made up some ground in April. That's interesting. Thank you, Deirdre. Deirdre Bose tracking DJT today, and we are tracking the overall market, which is under a little pressure, about 1/3 of 1% lower. Dow's hanging in there thanks to Amazon and some of the other blue chip names. It's going to be all about the Fed this afternoon. Of course, what Powell says, how hawkish he sounds, walking back rate cut expectations for the year, given some of the firmer inflation readings, and how he interprets some of the weaker data points that we've been getting, like GDP and job openings today.
Yeah. Qualcomm at eBay tonight, and keep your eye on crude, closer to 79 than 80. Let's get to the judge.
Q, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The Fed, the markets, earnings, the investment committee on the case, of course, on all of that. And joining me for the hour today, Joe Terranova, Jenny Harrington, and Steve Weiss. We check the markets. We're still green on the Dow. We're in the red on the S&P, and the Nasdaq's giving back about 0.5%. We all know what's on the table, though, don't we? The Fed this afternoon looming large. Joe, all sorts of questions about the economy, the rally, rate cuts, and everything else. How should we be thinking about this before we get to some big news about your rebalancing of the ETF?
I think the firm landing is here. I said that last week. I continue to see some moderation in the economic numbers. I'm hearing commentary on the part of CEOs, certainly what we heard from Starbucks last night, that the consumer is becoming more cost conscious. The effect of higher rates, the effect of inflation is real. It's impacting lower income consumers, and I don't think without question you could avoid that. So ultimately, what does that mean? I know some people have suggested, well, maybe the Federal Reserve puts on the table a possible one more rate hike. I do not see that as a possibility. I think the Federal Reserve walks a very fine line today, and ultimately what they deliver to markets, I don't think is going to be too disruptive and send the market into a deeper decline.
Sounds like what are you saying, that the bullish story's over? The firm landing's here. What does that mean?
I think the firm landing actually benefits. I think the firm landing benefits the premise that accommodative monetary policy is closer than we think. I actually think you get the rate cut at some point in 2023.
But we get it for the wrong reasons.
I took what he said the other way.
Yeah,
I took it that he's saying that's not going to drive the market lower, the Fed today, and that he's looking for the rate cuts. I took it as him saying it's a buying opportunity.
Is that what you think?
That's definitely not what I think. But is that what you?
In terms of the market overall, I think the market's going to run to a lot of different places over the next several months and ultimately go nowhere. I see a lot of risk-averse behavior internally within the markets itself. So I think if you're looking at the market right now, I know Adam Parker said 10% up, 10% down. He doesn't know. I don't know if I'd go with that wide of a band, but I think 5% either way. It's a coin flip at this point.
Wolf says they're still thinking 4,800 on the S&P. That the S&P and the Nasdaq are starting to resemble what they call bear flags. We could talk about support levels and all that. I don't want to bore you with any of that. But Weiss, give me sort of your disagreement with Joe. I mean, you're more bearish again?
I'm just saying there's a time to invest and there's a time to wait for opportunities. So I'm in the wait on opportunity stage. And again, not buying markets, buying individual stocks, idiosyncratic risk. I'm comfortable with. Market risk at this point, I'm not comfortable with. So that's how I look at it. I see no reason to rush into the market. We still have elevated valuations. They've moderated somewhat. But we're starting to see, as we heard from Starbucks, that it's starting to hit the consumer now. And it was only a matter of time anyway, unless we had seen those rate cuts already. Now it's unlikely we're going to see them anytime soon in the next few months. So what's going to control the markets? What's going to control the markets right now is what's happening with the consumer, what's happening with the companies. I'd say that this earnings reporting period, if you take out the big companies, which did quite well, and I'll put Meta in that, did quite well in the reporting. It was sort of nonplussed.
Let me ask you this: even if, let's just say, let's say we come away from today believing, what the journal characterizes it as, that cuts are on hold indefinitely. As long as we know that cuts are the next move, and we're convinced of that Powell doesn't make us think that, oh my God, they may actually hike. If we think that cuts are the next move, and the economy is going to remain solid enough, it's not like earnings are coming in trash. You can point to certain things that play into the bear case. You can point to certain things that play into the bull case. Why isn't that enough to keep the bullish overall story intact?
The way you put it is that if the economy stays where it is, then sure. But my bet is that this tightening policy has been going on for a really long time right now and should have hit the economy sooner, but hasn't because of all of the policy liquidity that's put into the market. I don't think that's the base case, that the economy stays where it is. I think the base case is that the Fed's focused on rates, they're focused on labor, right, employment, and right now you're seeing employment hold up. I discount the ADP numbers. I find them very unreliable, so we'll see when we get numbers tomorrow. But bottom line is, I think the economy is weakening because rates have been so high for so long. Okay. So that's not part of my base case.
I find it interesting, Jenny, that Jan Hatzius at Goldman has not given up the ship yet in terms of the belief that the Fed's going to cut it probably twice in their estimations this year, because as he says today, the two key pillars of the disinflation narrative are intact. Lagging official measure of shelter inflation, that's one. And two, the ongoing reversal of shortage effects for cars and other goods. So they're sticking with their forecast. July and November, you're going to get cuts.
Yeah, and I think he's right. I think that there's a really high chance of that. And then it goes back to how does the bull case, how does the bull story not then stay intact? And where I come back to on that is I actually go back to Wolf, and I think Wolf's right. 4,800 seems like a really plausible number. Why? Because you have reality, valuations, math, numbers, like whatever you want to call it, that gets in the way. And so here's the reality right now. 46% of companies have reported. 77% of them have beat. Oh, that sounds great. But actually, we're still on track for a quarter that's going to have growth of about up 3.5% year over year. What does that do? That puts us on track for growth of 12% year over year. What does that do? That gets you to $250 of earnings on the S&P. 4,800 divided by 250 is 19.2 times. A 19.2 times valuation on the S&P 500 is still quite positive. It's still almost one whole standard deviation above the long-term average of 16.6 times. So you can have a great story, but the valuation shows up as important. And we're seeing that in things like Starbucks, where Starbucks is a great story. I mean, probably just on the floor here behind us, there's like, I don't know, $300 worth of Starbucks, maybe more floating around. But valuations ultimately
But I mean, I'll
matter.
take your look, the people who are more bearish or cautious are going to seize any data point that they can to help build their case. You're making it sound like the Starbucks report today, as bad as it is, and the comps were surprisingly bad as they were, and the stock looks like the disaster it does. I'll take your Starbucks and I'll raise you an Amazon, and I'll raise you, you know,
great,
some of these other mega caps and AI
But
plays.
that's the perfect raise to support my story. So Amazon's up 2% today. What did it do in the last trading hour yesterday? It was down like, what, 3-4%?
Stock's been at an all-time high.
But in terms of the
Okay,
report,
but it's ultimately kind of flat, right? It's ultimately over the past couple days. And so it gets into valuations matter, numbers matter, expectations matter, and I think that there's too much froth. The thing that I think we're going to need to go back to really doing is when we talk about bear case and bull case, I think we need to start to talk about that with magnitude. And so do you think 4,800 is a bear case? Because that's down a few percent. It's not too crazy, right? If we think the big bulls out there who are at like 5,200 and 5,400, that's a bull case, like that's up a few
Jenny,
percent. It's not that significant.
Can I propose one qualifier to your market multiple? Okay. That market multiple that you cite is really with an average interest rate environment, right?
Good point.
Okay, so if you take a 19 multiple, is really reserved for
Right.
for easing, for lower, for accommodative policy.
Good point.
So if you
We're going to get accommodative policy.
But
We're
we
gonna
are.
get
We
lower
don't.
rates.
We don't have.
That's where the greatest debate is, right?
That's what it is.
That's the beginning,
whole
the middle, and the end.
However, what we're talking about
Right.
is that the market multiple at the time of where rates are, where monetary policy is, I would argue should be below 15 times historically.
I think that's aggressive, but
You're saying 15 times right now is the right multiple?
I'm saying historically, that's where if you take an average 14.6 times multiple, that's based on an average monetary policy. Here we've got restricted monetary policy.
Can we
I'm not saying it should get there. I'm not saying it should.
Make your next 2 points really quick because I got to move on.
Okay,
Go ahead.
Let's just stay on the point of this. I think in the last several days, we've heard from a lot of people that the premise of accommodative monetary policy is the next move, that we need to reverse that.
Neutral is the next move.
We need to reverse that. That, in fact, is not what I see. Inflation is no longer a global problem. Inflation is a domestic problem. The rest of the world, Europe, inflation is coming down aggressively, okay? Here in the United States, the Federal Reserve is talking about paring back the pace of quantitative tightening. That's delivering accommodative monetary policy in itself. So they're not going to come out today and say, oh, we might raise rates at some point this year. And the firm landing, let me just finish, the firm landing that I cited at the beginning of the show, where it's not just Starbucks, it's Harley Davidson, it's Whirlpool, that we've heard about a strained consumer. Firm landing, economic contraction plays right into the Fed delivers for the wrong reason.
There's a step between restrictive and accommodative, and that's neutral. We're nowhere near accommodative monetary policy.
Okay.
That's below 3%.
Agreed. We're not there now, but we're going to get there.
No, but here's the thing. I think we all agree we are higher for longer, right? And so actually, just this morning, I was talking to my friend about her 2.65%.
For a little bit longer.
I think a lot longer, because try and argue with me on this. I was talking to my friend who bought an apartment during the pandemic and has a 2.65% interest rate. Do you really believe that anyone in the next 10 years is going to see a 2.65% interest rate again? So even if the Fed's accommodative...
That's the litmus test of what that movement in the housing market? No.
I think it's a very good,
No.
representative
No.
point. But hear me out. So even if the Fed gets accommodative and starts to cut interest rates will be much higher than they are. So as people, even if mortgages and auto loans and credit card loans, even if all those come down, the rates are going to be higher. People are going to be servicing debt. That really pinches and hurts
Yes,
the
the
consumer.
world is not going to be a zero interest rate world for very much longer.
No, and so even accommodative doesn't actually make us go back to an environment, to Steve's point, where the market can comfortably trade on time.
Nope, because I want to hear the other Steve's point. And that's our senior economics reporter, Steve Leisman. As he awaits the decision and the news conference, he's prepping his questions as we speak. And I'm wondering how we should be thinking about all this. I hope and I presume that you've listened to our debate here. How's it relevant to what's going to happen today?
Obviously, you got to take the whole conversation you all just had, really interesting one, and put it into a large language model and see what the AI bot thinks about it. That's the key there, Scott. Look, I boiled it down to 3 different risks that are out there: an extreme, a moderate, and a low risk. I think most of the risk is to the upside today. But look, the worst is they introduce some kind of more than even possibility of a rate hike. I don't think that happens. I think the Fed backs off the outlook for the cuts, the moderate one. And the best possible scenario is this idea that inflation is seen as just a bump or a blip along the way. Look, there are 2 different ideas out there. You've got the kind of more extreme ideas of say, Larry Summers, who thinks, hey, the rate is not sufficient to bring down inflation. And then you have the other idea out there, which is that all we saw the last 3 months is just a kind of first of the year blip. That was embodied, Scott, in the Goldman report that you talked about, which I did read either last night or this morning, whenever it came out, that they're sticking with that forecast for inflation to fall. That's the view, by the way, of a lot of economists. And then you have this other layer, which is that, well, what's the real new news right now? And I think it's a cooling of the economy. Scott, I kind of pride myself in not being swayed too heavily by what companies are saying in their earnings reports. But the Starbucks one is probably the most interesting to me. I mean, look, people are addicted to this product more or less. They wait in line to overpay for coffee. If that's not happening, that to me is an interesting sign of perhaps gathering weakness in the economy. So I think what Powell does today is he plays for time and he lets this essential idea that the policy is restrictive, it is sufficient to bring down inflation, play out. And, you know, I know we're fast money and halftime and doing things in a hurry like there's a clock running. But remember, it's only a year this July that the Fed will have reached the peak rate. So that allows Powell, I think, to say, you know what, let's wait to see how all this shakes out. So I think he's not going to try to do much more harm. You have the market down about 4.6% from the peak. You have rates up about 50 basis points on the 2-year. The market tightened for Powell. So let him allow that to play out as it would on the economy.
You raise an interesting point when, you talk about Starbucks. We know that one of the ways, because they've told us, that the Fed gets its information is by talking to CEOs, right? It's just how they formulate a lot of their economic forecasting, because they don't have the benefit of seeing this data at the right exact time. So they go by conversations they have with CEOs to get a temperature take on how things are. You really think they'd be moved in a spirited way by this Starbucks report today?
I don't know about one report from one coffee company, although it's a bit bigger than a coffee company. I think as part of an input into things that the Fed looks at, I think it would be potentially swayed by it. But look, Scott, it really gets back to the discussion we had the other day on stagflation, where I kind of pushed back that, hey, stagflation is not a normal outcome here. What is supposed to happen? Well, maybe this is what's happening. Companies raise prices, prices get too high, too hot, and people back off buying it, and that causes companies to eventually reduce their prices or compress their margins. You need to throw that, by the way, into the conversation about where the right level of the stock market is here. But that's a process that normally happens. The economy cools as a result of rate hikes, and then you get lower inflation along with weaker growth. I think that's probably the best hope of the Fed. I think that's probably the outlook for the Fed. I think that's the one they're going to rely on, at least for probably several more months, as long as this inflation issue doesn't get worse. Remember, we're talking about 2.8% inflation. When we had an inflation problem, it was at or near double digits. I lived in a country where I went home, went to work in the morning with the Snickers being 25 rubles, and I came back in the afternoon and it was 50 rubles. That's an inflation problem. The Fed is very close on its target. Now, don't get on me on this other thing. The Fed is not going to solve the inflation problem the American people care about, which is the price level. It's targeting the rate. It's relatively close on the rate. It is not time, I think, it feels to panic here.
I also want to put into perspective, I appreciate that, Steve. I got to let you go, and I know you have to, and we'll see you later. I will certainly see you right after the chair is done with his news conference when we welcome in Jeffrey Gundlach. But Steve, I'll let you go. I'm also reminded, let's not take one report like Starbucks and act like it's the end of the world, okay, or the sky is falling. Because what was it, a week ago where Chipotle came out? Your Chipotle came out, and they've raised prices. Did they come out and suggest that consumers are all of a sudden not buying burrito bowls in the magnitude or for the price that they once were? So perspective is needed. Why are you smirking?
Yeah. I mean, look,
that's a fair point. Why?
I'm just cynical that if you're a management, and I'm not saying they're dishonest, what am I going to blame a miss on? I'm going to blame it on the consumer. I'm not going to blame it on my operations. I'm not going to blame it on losing substantial market share to every...
Dude, Starbucks' comps were a shocking miss. That's not blame, that's fact.
No, but I'm saying in terms of what you're blaming it on. Okay, it could be competition. I mean, in New York, and we're not alone. As I travel around, you see a coffee shop in every city. You know, so maybe it's not just the
Starbucks comps. I'm sure weren't down the magnitude they were as a result of competition from Blue Bottle or whoever else.
But that's why I pointed out that with the 46% of the companies reporting, even though there are 77 beats, so you can like pick and choose, cherry pick whoever you want. Collectively, those are only adding up to about 3.5% growth. Right, so like you can pick Starbucks, you can pick Whirlpool, you can pick Chipotle, pick them all.
We both have had reporting
it's kind of
histories
lackluster.
that have been somewhat jaded over the last couple of years also. There's not operational excellence there either.
Let's talk Amazon. So we saw the stock was up. Now, it didn't have a tremendous reaction to what was a strong beat. And AWS was the pillar of that. Weiss, which you own the stock, right? I think the number going in was 13% growth on the estimate. The whisper number had to be higher. We discussed that with Mark Mahaney yesterday. Like, it's got to be at least 15, 16, maybe even higher than that. Well, it was 17.
Yeah. On a huge base. It's a $100 billion business. It wasn't that long ago that it was a $60 billion business, as a matter of fact, about a year ago. So the growth is amazing. And you know what, Scott? The growth is going to accelerate because cloud is data storage, and you already have a multiplier effect without AI on data that needs to go into the cloud. Now think of what you're going to do as you're going to increase that as companies adopt more AI strategies, use their AI tools more in the cloud. So you got to love the hyperscalers. Its growth is just going to restart from where it was. And by the way, penetration, you know, it's not 100% across companies that should be in the cloud. You have a number, a high percentage still on-prem. So to me, that's the story. That's the heart of the story. and that's why I continue to own it. I'm not surprised by the muted reaction given the market backdrop yesterday and given the fact that analysts tripped over themselves over the last couple of months to be the highest price target on the street.
Well, they were chasing the target. I mean, they were chasing a stock that continued to go up and, as we said, hit a record high. Quick, what do you got?
No, all I want to say is, like, it all comes down to valuation. It's a 3% free cash flow yield, and that's kind of what it boils down to. It's a little too expensive.
Well, I mean, you would never, if you're going to say that today, you'll never own the stock.
No, that's not true at all. In fact,
You're going to own Amazon?
About a year ago, the free cash flow yield was like almost to our 5% hurdle. You know, so the answer is yes. Like, we were very, very close to buying both Amazon and Google about a year ago. And
Well, I mean, you're talking about apples and oranges in terms of valuation. Come on.
I think it's always been expensive.
That's my, I mean,
Okay,
it's
but if you
my
look,
obvious point.
It's expensive based on earnings, but if you look at it based on free cash flow, which is like, that's where the what is it, rubber meets the road, right? With what they can generate, that matters.
These companies don't trade in free cash flow, though.
Okay,
that
but
may
that's
be one of
where
your,
I
that's your
buy it.
discipline.
That's where
agreed,
I buy it.
agreed.
So I'm saying, like, from our perspective, it's still expensive. Why is it up 1% on a fabulous story? Because it's too expensive, because there is too much expectation.
All right, let's get into Joe's rebalance, because that is part of our big news of the day. As you know, it happens quarterly for the Joe T. And I guess the headline of the 32 buys and sells that you have all together is that you sold Apple.
And you are not surprised at that at all.
I'm not. You sold Tesla too.
Sold Tesla
so
as well.
The two fairly, I think we can call them the two weakest links of the Mag 7 stocks you no longer own.
Yes.
Tell us why, just beyond the bullet point of, well, they lost the quality and momentum.
No. So here's what happens. In April of last year, the strategy goes in and buys Apple at around 169.68, sells Apple at 170 yesterday. That's basically a scratch. So what is the strategy seeing? What is it recognizing? Number one, it's recognizing the negative momentum that has existed over the last year for Apple, and it's also concerned about the declining revenue growth. And the declining revenue growth for this company is real. If you look at the last 3 years, you're talking about 13% revenue growth. If you look at the last quarter, there was actually an acceleration up to, 2%. In the prior 4 quarters, you're talking about negative 70 basis points. And I could say the same thing about Tesla. Tesla, negative momentum. Now, I've said the other day on the show, I think Tesla's on a road to basically nowhere. I wouldn't short the stock. I wouldn't own the stock. But last quarter, the revenue's down 8%. You're looking at 47% higher over the last 3 years. The strategy sold Tesla at $200 in October, bought it back in January at $187. We're out here at $183, and I understand the reasoning behind both of those names. We're down to owning the Mag 4, Meta, Alphabet, NVIDIA, and Microsoft.
The danger in the strategy, as I see it, is that certain things that look like they have lost their momentum are troughing, and the turnaround could be in the not so distant future. Now, you're doing this, and we said the timing of all of this is tough for you because, Apple reports tomorrow. And, whereas the stock was at 165, maybe it was even a little bit below that, it's now back towards 170. You're going to get an AI announcement, we think, at WWDC next month in the early part of June. So this is a potentially difficult setup.
And I have no problem responding by saying, well, I'll sit here on August 1st if all that comes to fruition and tell you that we bought Apple again. Because the example that you're citing is exactly what happened at the end of January in 2023. And if the strategy is affecting itself correctly, then it quickly recognizes a mistake in removing a position or adding a position, and in the next quarterly rebalance, it corrects that mistake. And if you go back, that's exactly what the strategy did with all of the mega caps. Remember, this strategy sold NVIDIA in January of 2023. In April of 2023, it bought it back. The price of NVIDIA at the time was $275. So the strategy should correct itself, and I'm comfortable with that.
What's it can do with NVIDIA in June 2024, given how the stock's performing and performing today?
We'll see.
Well, May 22nd is the earnings report. So there's time. There's time to take good measure of it. You said you still own Alphabet, which, by the way, did you see this news that Third Point Daniel Loeb has taken a new position in that? And it was really around what he calls the blunders around the rollout of Gemini, but that it, created an attractive entry point for a longer-term investor. What do you make of that?
Just a quick comment on that. When we're scoring momentum and we're scoring the quality criteria, I want you to think about it, if you're a college basketball fan, about March Madness, about ranking the teams, and then you've got teams that are on the bubble. What I'm noticing with Alphabet is that the scoring for Alphabet continues to rise. So it's becoming an even stronger holding within the overall ETF itself.
All right, so AMD obviously is a big loser today as well after its earnings. That's going to which you still own.
Yes.
But that tees up a conversation that we're going to have next in terms of what you've done with your semi exposure, because you've sold a handful of names and you've only bought one. We'll document all of that next.
Will.com.
Welcome back. Chart of the day. Maybe it's obvious. AMD. Let's take a look. It's down sharply after earnings. Joe, we mentioned that you still hold it, but NVIDIA's down. A lot of these AI chip names are down. We make this decline of near 10%.
It is a normal reaction to what we heard yesterday. It's a normal reaction to where there was obviously a overbought condition as it related to position and sentiment itself. In terms of what we're doing strategically as it relates to semiconductors, we're taking down exposure. Exposure, based on the rules, has come down from 10% industry holding down to 7.7%. So we're beginning to see the deceleration after multiple quarters of growing the exposure to semiconductors. We still have a very strong representation there, but certainly not as strong as we had in the prior quarter.
Let me ask you this just bluntly.
Yes. I love bluntly.
How in the world do you still hold AMD based on your strategy, given the performance of the stock?
So, what happened yesterday in terms
even before yesterday?
Well, in terms of the earnings for yesterday, I mean, that would be the most obvious decision on it. But AMD, over the long run, has continued to move higher.
Well, the stock's down more than 20% year to date.
It is, but
isn't that a loss of momentum?
If you pull back the lens on that, where is the stock over the last year? Let's take a look at that. The stock over the last year looks pretty good. So we're studying momentum in a variety of different time periods, and 12 months is something of consideration to us. Over the last 12 months, you're talking about a stock that is 60% higher.
What is the most serious question? What's the most important time frame metric you look at to determine whether something's lost its momentum or not?
Great question. And we have an example later in the show of an equity that will help me get to the place in terms of my answer. But I think 12 months is the best representation. But what happens within the 12 months? Do you have significant drawdowns? That's problematic. Do you have a stock? So if I look at AMD right now, AMD is experiencing its first significant drawdown in the last 12 months. There are other stocks. I'll just get to it now. Freeport-McMoRan. Freeport-McMoRan came out of the strategy. It's a material company. Okay. You could look at Freeport-McMoRan, and the stock is near its high, right? It looks really good. Okay, but what happened to Freeport-McMoRan in the fall? It went down 20%. What happened to Freeport-McMoRan in the first quarter? It went down another 12%. So yes, you've reached that level of an all-time high, but there's extreme volatility embedded in that where you've suffered two significant drawdowns, and that matters.
So as a loyal shareholder, Joe T, can I clarify?
Sure.
So basically it's a scoring system. It's not one metric. It's not
it's absolutely a scoring system.
It's not just
without
time
question.
base.
Yes.
So it looks at various different metrics, and those come together with different weights, come together to determine what the strategies can do.
No, I understand it, but on a day and in a time where I think maybe more than any time in the last 12 months, stocks that have gotten an AI halo lift are being scrutinized in a way in which they haven't been to date.
NVIDIA, perfect.
Okay, so before it was like, well, everything goes up. When you say AI 50 times on your call, you go up.
Right.
If you're deemed to be an AI player, you go up. Well, PC's market's still squirrely. Gaming is somewhat anemic.
Right.
Data center outside of AI is questionable. Now, I just gave you 3 parts of AMD's business, arguably more important today than AI because they're in the nascent stages of creating these chips that are going to be able to compete
Let me
with
just
NVIDIA.
very quickly add one thing. I'm sorry, Jenny. One quick thing. Remember something. The rebalance and reconstitution happened at 4 o'clock yesterday. AMD's earnings were after that. So you see 9% lower. We weren't able to aggregate the earnings information into that.
Look, it's just a strategy you do, and you're beholden to the rules and the timing that you have to play by. Just quickly, so you sold Skyworks, you sold Analog Devices, you sold Microchip, onsemi, and Texas Instruments. You bought Qualcomm. So I gave you the ones you sold. I don't need to go through those. What was it about Qualcomm that you decided to buy it? Because they have earnings after the bell today.
Balance sheet continues to improve, and the momentum score, to Stephen's point, it's a scoring criteria, has flipped to what I call a green light positive.
Okay. Let's see with earnings. I mean, this is one of those instances where you try and get ahead of it, I guess.
It is what it is.
Yeah. Okay. Pippa Stevens has the headlines for us. Hey, Pippa.
Hey, Scott. UCLA announced that all classes were canceled today after the police were called in to put an end to violent clashes between pro-Palestinian protesters and counter-protesters overnight. The university said in a statement that law enforcement would be stationed throughout the campus and that Royce Hall, the building where the violence occurred, would remain closed until Friday. French police fired tear gas on May Day labor protesters in Paris today as thousands of people took to the streets demanding wage hikes, changes to working conditions, and protesting the war in Gaza. Some protesters are also calling to extinguish the Olympic flame ahead of the Paris Olympics this summer. But amid protests in the host city, the Olympic flame continues to sail across the Mediterranean Sea on board a 3-masted ship on its way to Paris. The flame is set to arrive next week in the southern city of Marseille. The torch will complete its 68-day relay across France when it arrives at the opening ceremony on July 26th. You'll be able to watch the 2024 Paris Olympics on Peacock and all NBC channels, including CNBC. Scott, back to you.
All right, Pippa, thank you very much. Pippa Stevens. Straight ahead, we have a check-in on healthcare. CVS is plunging today, Pfizer is popping, and Joe is selling a big name in that space. debate at all.
The NBC.
All right, welcome back. Take a look at shares of CVS today, down near 17%. That is a new 52-week low. That is after earnings. That's after Medicare was a big drag. In other words, if you see Farmer Jim, Surratt, Jason Snipe, or Amy Raskin today, throw them a little hug.
Yeah, that's my style.
Give them some good thoughts.
Yeah.
Because they all have a gigantic headache
Wait,
today.
I have a question. When I've been on and one of my stocks tank, have you ever suggested anyone throw me a hug?
No, but if you weren't here, maybe I would have. I wouldn't do it right to your face, but like these guys, they're not here, so I'm saying give them a little hug.
Yeah, you're gonna have to be talking to Joe. Talk to Joe and Jenny and that. It's not in my vocabulary.
We wanted to talk to one of them today. Shockingly, nobody was available.
You want me to take?
You know what that means?
They're in
so
CVS.
you know what to pay the next time they're on the show. All right. In all seriousness, Pfizer, staying in the space, they beat. Jenny, you own the stock. They raised their outlook as well.
Right. So it's the same investment thesis, the same argument that I've had all along, which is they just need to get past the COVID distortion. So they beat by 29 cents. They said revenues are going to be exactly where we expect them to be. They actually raised EPS to $2.25. And so what you end up with is a stock with a 6 and change dividend yield, trading at about 9 times earnings. Like, there's nothing spectacular here. There's no glorious story, but expectations are nothing. Valuations are reasonable. You get a 3% lift. I think this is a wonderful company to be in. If you just want to collect 6 and change yield for a very long time and maybe have it grow, I don't know, at like 3 to 8%. That's achievable. Nothing exciting here. Just getting past the COVID distortion.
Okay, so Joe, I use that as somewhat of a vehicle as I look here on my screen to get to Lilly.
Yes.
You sold Eli Lilly.
Yes.
In part of your rebalance at $781.10.
was purchased in October at 554. The reason is that the debt to equity continues to climb. Would I have preferred that the rules allowed Eli Lilly to stay in the portfolio? Yes. I believe Eli Lilly is a stock that at some point is probably a $900 stock. It basically trades like a biotech. But the rules are the rules. They're written a certain way, and the criteria that we look at as it relates to quality places a high emphasis on what your trajectory is for debt to equity, and the debt to equity continues to rise.
You ever get to overrule the rules?
No. No, you don't do that. Why would you want me to overrule
But
the
he
rules?
just gave me a great trade. I'm going to buy it now and sell it to him at 900.
But wait,
Okay, well, when it was 554, you said it was rolling
You
over.
could buy it
want
as
me
a
to buy
hedge
it.
now. You're going to buy it because you're in the JOT. You could buy it now as a hedge.
Yeah, good point.
Can I say something on Lilly? So,
Sure.
you know, we have a lot of individual clients, and a lot of individual clients come in with like really big legacy positions in Lilly. So I think a lot of the viewers probably struggle with that too. Like, what do you do with this? And I think, and I actually, you know, where I could, trimmed those legacy positions earlier this year, because what you've got is you've got a stock that's doing extremely well, but it's trading at many, many times the multiple of all of its peers. And I think that there is risk there. Like, if there is real competition in their GLP-1 drug, that stock could lose like 10 multiple points, 15 multiple points, kind of in a blink. So I think this is where like you really actually focus on the valuation and worry about that, as compared to the wonderful, like, oh my God, you know, GLP-1s are amazing story, which they are.
Okay. You got a quick point?
No.
Okay. Mike Santoli's next with his midday word.
Nine.
we are back with our senior markets commentator, Mike Santoli, is here at Post 9. All right.
Yep.
What's on your mind today?
I mean, market's still in testing mode. I think that's definitely the case in terms of not necessarily leaping to any conclusion about what they're going to hear from Powell. More importantly, our Treasury yields getting a little bit tired up at these levels. I think that's going to matter most in how the bond market reacts to what Powell has to say. You know, I pointed out yesterday and this morning that this is the level we were at before we started getting the hot CPI prints. So it's a matter of what's changed, what hasn't since then. The messy consumer earnings, the decline in oil, even the softer JOLTS report, you know, in a way could be all seen as helping out Powell in this case to say that disinflation is not over and we don't have to really sink the economy to get the job done. We'll see if that plays out, you know, in his responses.
You feel like the risk of a more hawkish Powell for the most part's in the market? At this point,
to a degree,
we've been prepping ourselves for days now.
I mean, I think to a degree, yes. I think nobody is expecting an outright dovish message. The room for a dovish surprise, therefore, is probably in there. I still think this isn't really crucially a Fed-driven market. It's more about, you know, let's get past this meeting. You know, we seem to be on board with the idea that we can wait a few months if the next move likely is a cut. So that probably holds up. I think the options market, though, is looking at a 1% S&P move after this meeting. I'm not necessarily sure specifically why, but that has been the setup.
I feel like we talked ourselves out of being a Fed-driven market, but now we've talked ourselves into, once again, sitting in that seat.
Well, you're getting challenged on both sides of the Fed equation, obviously, with the inflation numbers have not let you relax about the easing story. And then, you know, the growth, I think we overshot on the indomitable U.S. economy narrative. And now anything that complicates that and says maybe some consumers are hesitant, I think starts to create some doubt. But that's what the market needs. The market needs doubt because you had an excess of certainty at the highs and you want to kind of reset expectations. I thought you'd get, you know, even an 8% decline goes back to the old high of 4,800. That would probably reload things pretty well. I'm not sure we have to get there.
Yeah, we hear this commotion over your shoulder.
Looks like they're closed.
If that's the right word to use. There you go. There you go. You got the bell, which signifies the opening of Viking, biggest IPO of the year. Just opening for business. It priced at 24. That was the higher end of the range, and the stock's going to open higher by about 9%. They continue to have the festivities just behind us here at one of the posts, but yet another IPO on the floor of the New York Stock Exchange. We keep saying, well, maybe this is the beginning of a parade of them, maybe not so much, but nonetheless, it's a big day down here for Viking. Coming up, we have more of Joe T's big moves, energy, financials, they're front and center next.
in-person consultation.
Interesting move in crude today, lowest level now since late March. It brings us to you again, energy. Well, you've significantly increased your ownership here to 10.4% from 6.4. Give me a quick one, why, and then I'll run you through quick names.
Throughout the quarter, I'm tracking the criteria of which we're going to score on both the factors of quality and momentum. I knew that energy was looking as if we were going to increase exposure back once again. It goes from 6.4% to 10.4%. As you said, we added 5 names. We now own 13 energy names, and I knew once that was affected on the close that the price of spot crude oil would be lower today.
Right.
But that's not why.
Well, but that's what I'm thinking, like, right? You buy Conoco, EOG, Hess, SLB, and Halley. And I mean, at a time, I think where some are wondering whether the momentum in energy is running out.
Listen, it could be in the spot price of oil, but if you tell me that oil is going to trade in a tight band, and Mark Fisher said this a year ago with us, 65 to 85, boy, that's perfect for all of these energy equity companies.
Even if the economy continues to, well, let's say if it gets a little more squirrely, like you worry it might.
If it gets a little bit more squirrely,
you're predicting that.
No, if it gets a little bit more squirrely, then I think as you progress through the course of this year, the supply to demand imbalance becomes more in line, and yes, there could be pressure on the energy names.
Yes. Inventory's up today, by the way. Did you see that?
I did.
Okay. Regional banks. Boy, you picked up 5 regional banks.
Financials.
Cincinnati Financial, Huntington Bank Shares, M&T, Regions, and Hartford.
If you ask me what's the headline of the April 30th rebalancing reconstitution, it is the increased exposure in the financial sector. Steve, you're going to love this. 23% exposure
Wow.
now. 1 year ago, we were at 8.8. That's our second largest sector weighting. What's coming down? Industrials are beginning to come down lower and lower. Industrials had been the second largest. So we're adding names like CME, T. Rowe Price, RJF to the financial services names we already own.
Oh, you added back Berkshire.
We added back Berkshire without question.
You just sold it last rebalance,
We
right?
sold it. So we sold it on the last rebalance. We sold it at 384. We get it back here a little bit higher. Why did we get it back? Because we're seeing the improvement on the return to equity. That's an important quality criteria. So we have no problem. To your earlier remarks in the show, we have no problem going right back in once again. Regional banks, we picked up
We've
5
seen that with
regional
some of your
banks as
mega
well.
cap moves over the last year or so, couple years. All right, by the way, Berkshire's annual meeting is this Saturday. You can watch it on CNBC at 9:30 a.m. Eastern. So just give me a comment, shareholder.
Yeah, by the way,
Yes.
I don't love it because I don't like regional bank exposure because I don't think that accounts for, what we're going to see, the massive refinancing bubble coupled with a major write-down. And we just saw a bank in Philly get taken over this weekend by
Regions,
the Fed.
M&T, Huntington Bank, Cincinnati Financial.
Don't like it.
So you don't want any of them?
Don't want any of them.
You might be right.
I'm Team Joe on this one. Like, pick and choose. They're not all the same.
Okay, well, final trades are next.
FOMC.com.
A CFP.
Well, you know what's coming 3 o'clock Eastern time today on Closing Bell. That man right there, Jeffrey Gundlach, Double Line Capital. Right when the Fed chair finishes, we have a conversation about what the Fed chair just said, where interest rate policy goes from here, what it means for markets, and the best investments that you can make. So I hope you'll join me 3 o'clock Eastern time. Jenny Harrington, you are first.
Okay.
What's your final trade?
One Oak, they announced earnings. It's actually totally good news. Raised guidance, trading at under 16 times earnings, 5% yield. Meanwhile, the stock's down 2% today because the numbers were a little squishy just for this quarter. I'd buy it, I'd own it, I'd shut my eyes and enjoy the ride.
Weiss.
I'm going with Leidos. Leidos reported a phenomenal quarter yesterday. Since new management came in a year ago, each quarter has been better than the last. It's cheap and just perfectly positioned as a defense player.
All right. Joe T.
CrowdStrike. It was added yesterday to the Joe T ETF. I own it personally as well.
All right, good stuff. Thanks for all of
the
information on the Joe T. I'll see you at 3.
Scott, thank you very much, and welcome to the Exchange. I'm Tyler Matheson, in for Kelly Evans today, and here's what is ahead. It is the final countdown to the Fed decision on interest rates today. Market probabilities indicate no chance of a cut today, but could what Powell says move the markets one way or the other? We'll take you through the best and the worst case scenarios. Plus, 3 more names on deck to report. It's all about the consumer, inflation, housing. Our trader will buy 2 and fade 1 name into the print. and we'll tell you which are doing which. And speaking of the consumer, the high end mostly holding up. So far, so good. That's good news for TaylorMade, the company taking a big swing at athleisure with Tiger Woods' new clothing line. The CEO will be here to talk about that partnership, spending trends, and whether an IPO may be in play for TaylorMade. But we begin with today's markets and Dom Chu with the numbers. Dom.
It's wait and see, as you might suspect, on a Fed rate decision type day, Tyler. Now, we are seeing a bit of a mixed market, but it's fractional moves and not dramatically so one way or the other. The Dow Industrial is outpacing the broader market here, up 0.25%, 93 points. 37,908 there. The broader S&P 500 is at 5,019 right now. It's down 16 points, about 1/3%. Even at the highs of the session, we were down a modest 3 points and down a rather modest 22, perhaps, if you want to look at it that way, at the lows of the session. So again, very much a wait-and-see type trading range with the rate announcement coming up later on this afternoon. The NASDAQ Composite down 0.5%, 66 points to the downside for the NASDAQ Composite, 15,591. Here is the current state of play for the macro market as we head into that big rate announcement later on. The 2-year note yield ticking slightly lower, but still above that 5% mark right now, 5.02% there. The 10-year note yield drifting a little bit lower, 4.655% there. COMEX gold up 0.5%, 23.13. U.S. benchmark crude prices down 3.5% to $79 and change. And Bitcoin prices, they've been having a rough month so far. Now down below the 58,000 mark, 57,034, down 4.5% today. And then the big cap tech trade, very much about earnings in the S&P 500 these days. Amazon coming off a better than expected report. There may be forecasts left a little bit to be desired. Nonetheless, it's up 1.5%. Supermicro and Advanced Micro, both computer chip companies that disappointed in some way or another. Those are down big, about 10 to 15%. Alphabet and Meta, recent earnings announcements for the mega caps Magnificent 7 trade, up 1.5 to 1.75%. So Tyler, that's the current state of play with about an hour to go to that rate announcement. I'll send things back over to you.
All right, Dom, thank you very much. And as Dom just mentioned, we got less than 60 minutes until the Fed's decision on interest rates. Steve Leisman is now at the Federal Reserve with what to expect and what to watch for. Hey, Steve.
Tyler, good afternoon. It's a Fed meeting with, I'd say, mostly downside risks for investors, depending, of course, on how aggressively that downside may already be priced in. Talk about that in a second. The main question, just how sharply the last 3 months of bad inflation data have altered the Fed's policy outlook and what, if anything, they plan to do about it. Worst case scenario, I think, is Powell or the Fed introduces some hike possibility. The moderate case, I'd say the Fed backs off this outlook for cuts with a big question of how much they back off. Is it just temporary or is it something where it's indefinite? The best case is they describe the recent inflation spike as just a bump along the way. Possible changes to the statement include marking down growth to being seen as moderate. Inflation, they'll say, probably remains elevated. They said it eased in the last statement. And the high-risk change would be one if they say that the goals of low employment and stable inflation are not moving into better balance, as they said in the prior statement. Most likely, Powell and the Fed play for time here. The 2-year yield has increased most of this year, and stocks are 4.6% off their highs. That's tightened financial conditions without the Fed having to change rates. So Powell and the Fed, their job today might be best to describe it as do no harm. Keep rates high, but don't create an unnecessary spike in rates or a sell-off in stocks that may not be needed. Here are the probabilities for the day. Well, May is right off the table. That's today. June, just 9%. That was 99% a couple months ago. July, well, just a 25% or 24% chance. September, less than an even chance. So here you see the market really, to the extent that it has hopes for cuts, has really moved those cuts into the fall and into the winter, with December at 77%. Now, I think it's best to expect the most moderate changes the Fed can credibly get away with, given what's happened to the data. There remains a persistent view among a lot of economists that at least some of the inflation we've seen has been seasonal, and the Fed will likely stick to the forecast that its current rate is sufficiently restrictive to cool the economy, Tyler, and bring down inflation.
Two questions, Steve. Number one is whether or not in the statement there is a reference to the possibility of interest rate hikes being brought back onto the table. It seems to me very likely that the chair will be asked in the press conference a question about whether rate hikes are a live possibility again. What do you expect him to say?
I don't think hikes get into the statement. There is a kind of what would you say, lukewarm or backhanded bias towards cuttings, where they say in the statement that we don't expect the conditions to cut until we're confident. That could potentially come out. I don't think hikes go into the statement. I think Powell probably doubles down on this idea that our response to higher inflation is keeping rates restrictive for longer, not raising rates. I don't think he'll take them off the table, but I think he would say something along the lines of, it's not what I expect to happen.
Let me come to the question of the market as a predictor of what the Fed is going to do. As we entered 2024 or closed 2023, the market was predicting a very different reality than we seem to have encountered here. So my question then is, based on what the market is telling us right now, how much confidence should we have in what it's saying?
So, Tyler, I think of the question a little bit differently from how you posed it. Is the market's prediction for the Fed the right prediction for what both the Fed and the market believe the economy will do? The change that we had in the market's outlook is relative to the surprise in the data, both surprisingly strong economic data as well as stronger inflation data or lack of progress in data. That's what caused the change. So the market, I guess, the question is not do they have the Fed wrong? The question is, have they had the economy wrong? And I think the answer is yes, they have. That they've had the inflation trajectory wrong. They expected more inflation progress. They didn't get it, so they backed off. So this is the right call. Right now, Tyler, what I like to say is the market's prediction for the future is 100% correct for what they believe today is going to happen tomorrow.
Yeah, well, it's very interesting as we talk about inflation and the Fed's ability to predict what it's doing. You just said that they have been wrong in their prediction of the trajectory of inflation going down.
Right.
They were also wrong with the projection of inflation as it moved up. They called it transitory.
They called it transitory, but let me tell you another place they were wrong. If you want to go for strike three, they were wrong that inflation was going to come down as quickly as it did. Everybody was surprised at how much progress there was going to be, that there was in 2023. So what happened is they rolled over that trajectory into 2024, and it turned out, at least for the first 3 months, not to be right. But there are people like Goldman Sachs, they wrote a piece this morning, and they said, you know what? We're sticking with our call for inflation to come down. That's one idea. On the other hand, you have people like Larry Summers who say, hey, all of this inflation, this strong economic growth tells you that the funds rate is not restrictive enough, and Summers is out there predicting that they're going to have to raise the funds rate, or suggesting that Fed may have to raise the funds rate further. So I think the story is, Tyler, everybody has been humbled here by this post-pandemic economy, perhaps by how much fiscal spending has meant to the economy, perhaps by how resilient the consumer is. And of course, I think we're all been a little bit surprised at how resilient companies and profits have been as well.
All right, Steve, thank you very much for setting up the conversation. It will continue now for the next couple of hours. Meantime, while the odds are rising that the Fed could be on hold for the rest of the year, two of our next guests do still expect interest rate cuts. Joining us now, Subhadra Rajappa, head of U.S. rate strategy at Societe Generale, Julia Coronado, founder of Macro Policy Perspectives, and Mike Remack, head of investments at Citi Global Wealth Network. Welcome to all three of you. Steve set up the conversation very adroitly there. I think you will agree on what could be going on. Subhadra, you're one of the three here who don't expect interest rate hikes this year at all. Why?
Yeah, I mean, I think that as Steve was talking about, inflation, growth, the jobs market, and the general resilience of the consumer leads us to believe that the Fed will probably wait until after the elections to cut rates if they wanted to. You look at the market pricing, as Steve was pointing out, the market's not pricing in a cut for mid-year, so June and July is out of the question. September is a coin toss. The earliest the market has priced in for a rate cut is either at the November meeting or at the December meeting. So I think that there's a case to be made, given how strong the data has been, that the Fed wait at least until after the elections to think about cutting rates.
But you don't expect there to be a rate hike, so you would say that the next move the Fed is going to make is probably lower. But then the question for me becomes, as we embark on a rate lowering cycle, where is that terminal lower rate likely to be? In other words, how much higher is it likely to be than we've become accustomed to for interest rates?
So as far as the market pricing is concerned, the pendulum has completely swung the other way. Coming into this year, we were expecting perhaps a terminal Fed funds rate in and around the long run rate of 2.5%. But the market's saying that that terminal Fed funds rate should be perhaps above 4%, maybe even above 4.5%. So that's a very dramatic change in the market's perception of what the terminal Fed funds rate should be. I mean, our view is that the Fed is going to wait for as long as they possibly can before they start cutting rates. But once they cut rates, the terminal Fed funds rate is probably going to be above 3.5% when it's all said and done. We'll just have to see how the data plays out.
We'll come back to that and its implications for the economy, but it's a different spin on that phrase, higher for longer, is basically what it is. Let me turn to Julia Coronado, if I might, and ask a question that I asked Steve a moment ago. It seems unlikely that the Federal Reserve statement, said Steve, will include any reference to the possibility of raising interest rates at this time to combat inflation. But it seems very likely, I think you would agree, that the chairman will be asked about that. What do you expect him to say? How will he dance on that head of a pin?
I think that what he'll say is that it's not something that they have discussed, and it's not something they think will be necessary at this point. That so far their strategy of holding rates at what they believe to be a restrictive level for a longer period of time is the right strategy. But at the end of the day, they'll follow the data. So he'll confirm data dependency, and he will also confirm their commitment to restoring price stability. So he's always very forceful and strong in saying, we'll do whatever the data dictate in terms of restoring price stability. But at this point, I think Chair Powell is not going to want to indicate any degree of panic given the firming in inflation in Q1. There are a lot of reasons to think that progress will resume as the year unfolds. So let the data deliver. If the data don't deliver that cooling trend as we move through Q2, then that conversation might shift. But one thing Chair Powell said coming out of the IMF meetings that really struck me in a world of global currencies that have been as volatile as they are, he said they understand well their job as keeper of the global reserve currency, and that their job is to be very transparent and communicate their thoughts and their approach as clearly as they can so as not to induce unnecessary volatility. We've seen a lot of volatility in the yen and currencies generally. The U.S. as the outperformer of the global economy really sets us up as the safe haven for capital flows. So I think all of this says Chair Powell should be calm, cool, and collected, hold the line on the current strategy, but also their commitment to bringing inflation down over time.
Mike, let me turn to you with a question that is maybe sort of lurking off in the background a little more maybe than it should be, and that is the runoff of the Fed's balance sheet, quantitative tightening, if you will. What do you expect, if anything, for the Fed to say about that and for the pace of the reduction in the balance sheet, which is monetary tightening by another means?
Yeah, I think that's going to be the big question for today. I mean, what we're not expecting today are any major surprises. The focus will absolutely, as you said at the top of the hour, be on the rhetoric, on the language, and what that portends for the remainder of the year. The one point that we are watching, though, however, is that quantitative tightening. Do we start to taper that back a little bit? We think if that doesn't happen this month, it's probably in the cards in the near term. We've seen that this is a Fed chair that really likes to telegraph, to be transparent, and to get ahead of the trend. So I think that would obviously be positive news for the market if we do see that today. That's going to be the one material outcome that we're waiting for.
And you're of what view with respect to the number and magnitude of interest rate cuts this year, if any, Mike?
We've said all year long that this last mile is going to be choppy, and we are cautioning investors that you really have to, not read too much into what's in store for the remainder of the year. We're sticking to our guns with a 2.5% inflation target for the end of the year. We do think that the Fed will still have room to cut rates before the end of the year. Our base case, believe it or not, and I know this is outside consensus, but our base case is still at 325 basis point cuts before the end of the year, even as we sit today.
And Julia, your view is, if I'm characterizing it correctly, and correct me if I'm wrong here, that the Fed will start to cut rates and that the rate cutting cycle will be sort of an every other meeting pace into 2026. And so where does that bring your terminal rate as opposed to Subadra's?
You know, I think ours is probably a little bit lower than Subadra's, and the pace will ultimately be dictated by the data. I think they certainly aren't going to use words like measured pace and promise a slow pace of cutting like they did last cycle. But we do expect that this resilience we're seeing in the economy is going to be with us. If it is, they can afford to go sort of gradually and carefully and calibrate that rate to the economy. And like Subhadra, I think there's a number of reasons to think the terminal rate's higher than last cycle. We don't have household deleveraging. We have more fiscal support, and a lot of reasons to think that it will be higher. I would probably put it closer to 3 to 3.5. Ultimately, at the end of the day, I think there's a lot of lags in policy that have yet to come through. Things like the mortgage lock problem and businesses also locked in low rates means that we really haven't paid the price of higher rates yet, but we will over time as debt rolls over.
Let me change the spin, Subhadra, a little bit. It is a political year, so I guess no one should be surprised that the Fed has, in recent days, been brought into a political conversation about its own independence. Stories in the Wall Street Journal late last week and over the weekend indicating that certainly people in the Trump camp have been wondering whether there are ways that the executive could be more influential with respect to monetary decisions on the Fed. Talk to me a little bit about your view on Fed independence, how important it is, and whether you give much credence to the stories that ran last weekend.
So the Fed is bound to the congressional mandate of
It reports to Congress.
Yes, they do. I mean, you hear Chair Powell doing his semi-annual testimony in front of Congress. So for the most part, I think that the Fed is accountable to its dual mandate. I just don't see the need really for any change in what has worked out really well for over a century. The Fed has remained independent, and the reason for that is the fact that business cycles and economic cycles don't coincide with presidential terms. So it's important for the Fed to have that in mind and look at sort of the longer-term picture for what's good for the economy. So I don't really see any meaningful change coming through with more perhaps involvement from the executive branch in this particular, regardless of who gets elected. I think independence, or the Fed's independence, is going to be paramount.
And Congress would yield its supervisory powers very jealously, or would protect those very jealously, I should probably say. Folks, I wish I could have gotten Mike and Julia to you on that same question. Alas, we are out of time, but we will come back to it. I'm sure it's going to be a topic that will resurface during the course of this year and into the future. Subhadra Rajappa, Julia Coronado, Mike Remak, thank you very much. Let's move now to high mortgage rates continuing to keep potential buyers on the sidelines. Julia, Diana Oleg has the latest numbers. Hi, Di.
Hey, Ty. Yeah, mortgage demand dropped again last week as rates hit the highest level since early November. The average on the 30-year fix rose to 7.29% for last week from 7.24%, and that's for loans with 20% down. That rate is 79 basis points higher than it was 1 year ago, and that's why applications to refinance a home loan, which are highly sensitive to weekly rate moves, fell 3% for the week and were 1% lower than the same week a year ago. Applications for a mortgage to buy a home fell 2% for the week and were 14% lower than the same week 1 year ago. But here's the headline in the report. Demand for adjustable rate mortgages hit the highest level of the year, nearly 8% of all applications. ARMs offer lower rates. In fact, last week, a 5-in-1 ARM fell to 6.6%. ARMs can be fixed for up to 10 years before adjusting to the market rate. The less affordable housing becomes, the more demand we see for ARMs. You can just compare it to 2021, when the 30-year fix was around 3%. armchair demand was barely 3% of the market. So rates have moved up even further this week, now around 7.5% as of today. That's roughly 50 basis points higher than where we were just 1 month ago. And to home buyers out in today's super pricey and competitive market, that's real money on the monthly payment. And Tyler, you know, you don't buy the house, you buy the monthly payment.
You buy the monthly payment. You would have to guess that the share of adjustable rate mortgages is going to continue to expand if interest rates stay roughly where they are today. And why wouldn't you go for a 5-1 ARM on the theory that sometime in that 5-year period, rates are going to come down, you're going to get a chance to refinance and maybe lock in what is, by today's standard, a more appealing fixed rate?
Yeah, it's absolutely what you should do. And you can even fix for up to 10 years. You know, adjustable rate mortgages are considered riskier because at some point they will adjust to what the market is. But the market could be lower than it is today. And as you said, if you expect rates to be lower in 5 years, as long as you're at least 50 basis points lower, that's when a refinance makes sense for most homeowners. If it's close, the refinance is too expensive and the math doesn't really work out. But again, if we expect rates to go much lower in the coming years, a 5-1 ARM is perfect.
Yeah. I've had almost all of the different types, Diana, in my long and unsuccessful career in real estate. Diana Olick, thanks very much. Coming up, we're halfway through the busiest week of earnings season, but it's not over yet. We've got 3 of the biggest insurers, plus Zillow and DoorDash on deck. The action, the story, the trade, they're up after the break. And for the first time in nearly 3 decades, Tiger Woods will be sporting something different from his signature red Nike shirt. We will give you an inside look at the golf legend's new apparel line with the CEO of TaylorMade, the company behind Tiger's new Sunday Red brand. And less than 40 minutes till the Fed decision on rates. The Exchange is back after this.
This is The Exchange on CNBC. Prices go up.
The Treasury Department issuing some new sanctions, and Eamon Javers has this breaking news. Hey, Eamon.
Tyler, these sanctions are coming from Treasury's Office of Foreign Assets Control, just posted within the past couple of minutes. And they're listing now hundreds of entities and individuals who are being sanctioned for support for Russia and Russia's military-industrial base. What's interesting about this list, as we're looking through it now just for the first time in real time, is that there appear to be dozens or more companies on this list who have been sanctioned who are in China. This is the first time we've seen that, and it follows, of course, on the heels of the Secretary of State Antony Blinken's visit to China just last week, in which some of these issues were discussed. So to give you a sense of the flavor of some of these sanctions that we're seeing, companies named include Chengdu Keylink Wireless Technology, which is a company in Sichuan province, China, which is being sanctioned for its material support for the Russian Federation's military-industrial base. Also, Chip Space Electronics, which is a Hong Kong-based company, according to the Department of Treasury, also added to this list. An aero engine manufacturing company that's listed as in Chongqing, China. So a variety of companies here now facing sanctions for material support for Russia's wartime effort here in Ukraine. And the key wrinkle here diplomatically is that a lot of these companies are in China, guys. Back over to you.
Very interesting, because last week, Secretary Blinken, when he was with Xi, said effectively, if you guys don't clamp down, we will. And this is that we will part, right?
Yeah, this is clearly the follow-through on that conversation, but also clear that, the United States telegraphed this to the Chinese side. This will not be unexpected now to the Chinese side that this is happening. And it gets at this relationship geostrategically between the Chinese government and the Russian Federation. There are some that argue that the war in Ukraine now has effectively become a proxy war for the Chinese against the West, using Russia as their proxy in the same way that the United States and Russia had proxy wars during the Cold War, that this is a new Cold War proxy in which Russia has now become the proxy of China. And this now would be the U.S. effort to get at the root of that and at least eliminate some of the economic support.
History never fails to give us with lots of surprises. Eamon Javers, thanks very much. Appreciate it. All right, time now for our earnings exchange, and we are going to trade insurance, housing, consumer names today. Here with the trades, Delano Saporu, New Street Advisors founder and CEO, and a CNBC contributor. Welcome. Good to have you with us. Let's kick things off with three insurance names that report after the bell. You got your Allstate, your Aflac, and your MetLife, all higher so far this year. Investors watching for increases in premiums to offset uncertainty in claims level and investment income. What do you think of this trio?
Yeah, this trio is not too bad at all. I would buy Allstate and probably hold the other two names. You're looking at optimism is the name of the game here. You've seen a rise in insurance claims. You've seen auto insurers, especially with Allstate, have a difficult period recently. And you're also looking at underwriting losses because of those things. But I do have optimism that pricing will improve for a lot of these auto insurers. And you'll see that during the courses of this year. And you also look at Allstate, they were able to raise some of their prices when it came to their insurance policy. So I think, you're looking at it, it's optimism. You're holding or you're buying if you really like these names, and you're kind of waiting things out.
All right, let's go next to housing, and that would we're going to feature Zillow here, down around 25% in 2024 so far. Higher mortgage rates not helping, continued housing shortage, uncertainty stemming from the National Association of Realtors settlement on commissions. Do you like Zillow here? Delano.
This one I'll be more cautious on. You just mentioned the NAR ruling that had an effect on a lot of the real estate stocks and obviously a negative effect on Zillow. And if you look at it, it's because of the impact on spending and lead generation that they'll probably potentially see going forward. Marketing budgets could be reduced if agents' commissions are reduced. But the housing market that was prior in 2022, 2023 is generally gone in a lot of places if you look geographically. So for those reasons, I'd be waiting to see what they do to shift strategy going forward to potentially negate any of the things to the NAR ruling, and then potentially be able to go back into the stock.
Very interesting. And we will end with a company that my son, I think, single-handedly is holding up here. DoorDash up more than 30% this year. Canaccord watching for consumer weakness. There's none in Mac Matheson's budget, by the way. We got a strong market share for DoorDash, favorable labor landscape. Those are the catalysts for the stock. What do you think of DoorDash?
Now, I'm right with your son, Matt, especially during the COVID times. And a lot of really domestically, a lot of us were. And I think that they've seen those elevated orders and their core business stick around even after the pandemic landscape. So if you look at it, that industry is going to continue growing. So I like the stock here. I also like the international expansion that DoorDash plans to do in different markets, right? Especially Eastern Europe. They've penetrated the U.S. obviously really well, and they're trying to do the same things across the seas. So I like the stock.
Delano, thanks. Always good to see you, sir.
Thank you, Tyler.
Appreciate it. Quick programming note, folks. Don't miss the CFO of DoorDash, who will be delivering his thanks to my son in a CNBC exclusive interview after earnings. That is on Closing Bell Overtime today in the 4 p.m. hour. Still ahead, here's your first look at today's mystery chart. The stock having its worst day since the turn of the century. We'll reveal it ahead and tell you why Jim Cramer says the company is facing a threat to its very existence.
The problem here is one of trust. It's difficult to come on air and say things that are good. I would have called for more of a truth and reconciliation discussion and more of a realization that it's existential. So I am distressed about the situation.
Welcome back. I'm Pippa Stevens with your CNBC News Update. Arizona state lawmakers are making a final push to repeal the state's Civil War-era abortion ban. 14 Democrats in the state Senate are hoping to win over at least 2 of their Republican colleagues to win final approval of the repeal bill, which the state's lower chamber passed. If the bill is signed, a 2022 law banning the procedure after 15 weeks will be the prevailing law. A new FBI report finds older Americans lost billions of dollars in scams last year. According to the agency, financial crimes against people older than 60 totaled $3.4 billion in 2023, an 11% increase from the year before. The FBI says at least 101,000 people in this age group became victims. The biggest losses came from scams involving Bitcoin and other cryptocurrencies. And Ford is recalling 240,000 Maverick pickups because their taillights aren't lighting up properly. Federal regulators say the issue could increase the risk of a crash. The recall affects certain trucks from the 2022 to 2024 model years. Tyler, back to you.
Pippa, thank you very much. Inflation has big brands warning of consumer weakness yet again this earnings season. Names like McDonald's, 3M, Newell brand saying it is pressuring low-end customers. But luxury also showing some signs of slowing spending. LVMH, Keurig, both reporting drops in revenue, citing sluggish market conditions and rising geopolitical tensions. But spending in at least one niche area has been climbing over the past 5 years and likely got a boost during the pandemic as everyone went outside, and that's golf. Global sales of golfing equipment up 40%, apparel up 21% since 2019, this according to Golf Data Tech. And there's a new entry in the space with a big name attached to it. Tiger Woods launching his Sunday Red brand today after ending his 27-year partnership with Nike back in January. Joining us now is David Abelies. He is the CEO of TaylorMade, the parent company behind Sunday Red, and Dom Chu, who is a golfer.
I am a golfer.
Joins us as
I am an avid golfer, as you are, Ty.
Ask David the first question.
I would like to know why TaylorMade is getting into the apparel business in a big way, even if I know the reason why is because it's Tiger Woods, but why TaylorMade and why so much into apparel?
Well, I appreciate that, Dom, and it's nice to be back
Nice to
with
be
both
with
of
you.
you gentlemen. Why not? Why not? We've built an incredible platform at TaylorMade, one in which most of you know well and your audience knows well. We have three specific businesses. We have an equipment and golf ball business, which is a core and legacy business for us and doing very, very well in the global marketplace. We've got an investment in entertainment and a concept with Tiger Woods and Pop Stroke Entertainment, which is 36 holes of synthetic putting. But it was a very, very logical adjacency for us, given the history of the company, our understanding of the apparel and footwear markets, and the total addressable market, not just for apparel and footwear in golf, but athleisure and lifestyle outside of golf, to find the right position to bring an apparel and footwear brand to life. And so we've been here in New York over the course of the past couple of days with our partner Tiger, bringing Sunday Red to market, and it's been a wonderful opportunity for us to expand the comprehensive nature.
So I guess the flip side of that question is, what took you so long on this? I mean, you have hats, I know that because I wear one, but the other apparel, you're kind of a late entry here. And is footwear a part of this or not?
Sunday Red is an apparel and footwear brand. Tyler, to answer your question, we've been working down a multiple pathways to get into the apparel and footwear business. We do collaboration work with other brands that include TaylorMade apparel in different markets around the world, domestically and internationally, which is a nice business for us. But we don't own those brand marks. We own the TaylorMade brand marks, and it's really an adjacency or an accessory to the things that we do. We've looked at other acquisition strategies to determine, is there a good fit for us where we could take a regional brand and nationalize it, or a national brand and make it global. But about a year ago, we had the opportunity to engage with Tiger's team and start to think about other concepts. And Tiger's been part of TaylorMade since 2017, when he became a TaylorMade athlete playing our equipment, which has been wonderful for us.
Nike went out of the business of making equipment.
They exited in 16. He came to us in 17, which was really terrific. And he's been incredibly helpful in helping us think about technology, think about design language. And some of those technologies, while most golfers might think they're organic to him, Dom, they actually meet the needs of player profiles in every skill level. So when we had an inclination that potentially Tiger was considering other options relative to his future in apparel and footwear, and we thought about where we've been, but importantly, where we want to go, to bring a new brand to market, to bring a new option to the TaylorMade portfolio of brands and categories, this was a very, very clear synergy for us, and so we got started.
Can you tell us a little bit? First of all, TaylorMade is a private equity-owned private company. We don't know a lot about your inner workings or financials. Can you take us through what you can tell us about the structure of this agreement? Is Sunday Red part of TaylorMade? or is it a separate venture that you and Tiger have interests in? How exactly does the structure set up?
Yeah, fair question. We are privately held, so at this point in time, we don't disclose a lot of what our public peers might. The TaylorMade Holding Company owns the Tiger Woods Sunday Red brand. So Sunday Red is a wholly owned subsidiary of the TaylorMade Golf Company.
It's a brand within a brand.
Well, it's a brand within a portfolio.
Within a portfolio of brands.
Independent brand
Okay,
within
fair.
a portfolio of brands, with which Tiger is partnered into. And so Sunday Red is not based in Carlsbad, California, which is the world headquarters of TaylorMade. It's based north of us in San Clemente, so we can leverage the talent in apparel and footwear, fashion and design out of Orange County in Los Angeles, and the organic golf talent that you would find in San Diego. So we're based in Orange County. Separate management teams, separate product teams, separate everything, because we believe this brand should stand alone. The categories are uniquely different than designing and developing equipment and golf ball. And so Sunday Red is an independent subsidiary of the company.
So Dom asked you intelligently about the private equity structure, your ownership structure. The natural, logical next question is, what about an IPO?
One of the things that Sunday Red brings to our business, on top of our investment in PopStroke and our partnership with PopStroke Entertainment and the legacy business, which at this point in time is the largest of our portfolio, the leadership and equipment that we enjoy around the world and the strength and momentum we've established in golf ball, that provides us optionality to return capital to our shareholders across a lot of different potential pathways. So we haven't made a determination at this point in time, ultimately, what that will lead to. We have always believed that we follow the compass, not the clock. And what I mean by that is if we create real value for our customers, true value for our customers, our shareholders will benefit from that. There's no doubt that Sunday Red will be additive to that philosophy.
Can we talk about the big picture really quickly? We talk to a lot of golfing CEOs, as you know. You watch CNBC. One of the things many of them have told me about is the normalization of golf post-COVID. Tyler mentioned COVID before. The growth rates are going to be hard to replicate. How exactly are you as a CEO navigating what you think the new normal is for golf post-COVID pandemic?
Yeah, there's a lot of ways, Dom, to answer the question around normalization. If normalization is up 40% from pre-COVID in equipment sales, from pre-COVID baselines, and 19% in apparel and footwear, we'll take it. That's great. The beautiful thing is we've seen millions of golfers, both on-course golf and off-course golf, come into the game over the past several years. And they purchase in different cycles and different stages of their playing abilities and development. We talked about your kids, right? What will your kids be playing, not just today, but 5 years from now and 10 years from now? And then the replenishment cycle of those that have come into the game from recreational or starters to more advanced players. So we are bullish on the state of the industry right now. We believe that for the foreseeable future, we'll see constant and predictable growth, which enables us to run a very effective company and drive profitability across our business platforms.
And contributes to that optionality that you talked about. Next, I've got to leave it here, but the next big thing in materials is carbon, you said. Carbon.
It is. We believe we are in the carbon era, right? One of the beautiful things about advanced technologies and innovative companies, TaylorMade, selfishly, I believe the most innovative of all, because we're willing to take on risk of new design language and new materials management for the benefit of golfers of all skill levels to play better. We have entered the carbon age. And so we no longer, as I was sharing with you at the break, Tyler, make drivers out of titanium faces. We have 60-ply thermally compressed carbon in the QI10 products that Nelly and Scotty are winning with, that Tiger and Rory are playing with. Rory won last weekend.
So this is one place where the carbon footprint is a good thing. David,
the carbon footprint is a great
we got to
thing.
leave it there. Thank you, my friend. Dom Chu, thank you.
Thanks.
Got to leave it there. All right, we've got a quick news alert on Google. The tech giant laying off at least 200 employees from its core organization. That's according to a scoop from CNBC.com's Jennifer Elias, the core unit of the company responsible for building the technical foundation behind the company's flagship products, as well as protecting users' online safety. As part of the unit's reorg, Google will move some of the positions to India and Mexico. The layoffs happened just ahead of the company's blowout earnings report last week. Coming up, this name down about 17% after missing on earnings and slashing guidance. That has bearish sentiment on the street brewing. The name and what's got analysts concerned. That's next. We'll be right back. Welcome back to The Exchange, everybody. Let's get some show and tell, where we show you a chart and then tell the story that accompanies it. Shares of Starbucks, that was our mystery chart, getting slammed after the company missed on both earnings and revenue. Surprising sales slump here. The company also slashed guidance. Here in the U.S., sales decreased 3%. Traffic sank 7%. Second quarter in a row of struggles as the company's home market. CEO Laxman Narasimhan told Squawk on the Street that while the occasional customer is clearly cutting back, Starbucks has a strategy to win them over. The Street is not in.
It is true we had a tough quarter, but we have an action plan against that, particularly on how we communicate and deliver value to those occasional customers that will see value when they see what we offer them.
And the Street not entirely convinced. Both William Blair and Deutsche Bank downgrading Starbucks to a hold equivalent, and both cautious on management's lack of transparency about when they expect customer trends to improve. Coming up, Apple set to report after the bell tomorrow. Sales in China down 13% last quarter. There are some potential bright spots on the horizon. That's next.
Humanly possible.
Welcome back, everybody. Apple set to report after the bell tomorrow. Shares are down 14% this year. One of the biggest headwinds there is China, demand there. But there could be some hope on that horizon. Steve Kovac joins us now to discuss. Steve, what's new in China?
Not good. That's the real answer, Tyler. So after last quarter, when we heard Apple report that sales were down in the December quarter 13%, we're getting more troubling data in this current quarter that paints a pretty dark picture ahead of earnings tomorrow. We're seeing some data come out from the likes of research firms like Counterpoint Research saying that iPhone sales in China were down. You can see right here, down about 19% from the year ago quarter. At the same time, we're seeing a resurgence in some Chinese brands, especially Huawei. That is the Chinese brand that was out of the smartphone game for a little bit because of some export restrictions in the United States. They weren't making phones for a while. And now that they are, we're seeing more and more evidence that people in China are choosing those devices over the iPhone, but there may be some hope on the horizon here. Tony Sacconaghi, rather, of Bernstein, was saying earlier this week that this could perhaps be a cyclical thing, kind of like we saw in China back in 2019, and it'll shake out with the next iPhone cycle.
So it's hard to understate, is it not, the importance of China to Apple, not just as a manufacturing base, but also as a market. How big a percentage of, let's say, iPhone sales or revenues is China?
Yeah, we could talk about total revenues. It is, last year, it was just shy of 19% of Apple's total revenue for the entire fiscal year. It's been as high as 22, 24% for the year as well. So 1/5 or approximately of Apple's business comes out of China. Forget about the manufacturing and so forth out there. This is a huge customer base. And in the meantime, we have not seen Apple find another growing market that can kind of make up for this downturn that we're seeing in China. We saw Tim Cook in India last month, rather, it's May now. Last month, he was in Southeast Asia, touring Singapore, Indonesia, Vietnam, these countries that, sure, sales are growing there, manufacturing's growing there, but nowhere near close to the levels they need to see in order to make up for those downturn in China.
Steve, what's the over-under on the number of times you'll appear on television tomorrow?
Oh, about 500, I think. It's going to be a lot.
We'll see you tomorrow on Apple Day.
Day.
Steve Kovac, thanks very much. And that will do it for this edition of The Exchange. We are just 6 minutes away from the Fed's decision on interest rates. I will see you on the other side of this quick break. Get ready for the countdown to the Fed decision.
And come ride with us.
Welcome to Power Lunch on a Fed Day, everybody. I'm Tyler Mathisen. We are just 4 minutes away now until the Fed's decision on interest rates. And let's get a check, meantime, on where the markets stand as we head into it. Some big reactions on earnings, among other things. There you see the industrials, the loan index that is markedly higher by 113 points. But the S&P 500 and the NASDAQ composite are roughly flat, let's call it. Starbucks, meantime, falling to a 2-year low. Supermicro losing more than $100 a share. we've been talking a lot about that one. On the upside, however, is Pinterest up nearly 18% at 39.35. Meantime, let's get right to our all-star panel with the Fed's decision just minutes away. Joining us are David Kelly of J.P. Morgan Asset Management, Kristen Bitterly of Citi Wealth, and Jim Caron of Morgan Stanley Investment Management. Let's talk a little bit. Welcome first to all of you. David, let me begin with you and just sort of get your thoughts as we head into this meeting. I know that you are sort of in the camp that says there ain't nothing coming, but we got to listen to what gets said.
Well, yeah, I mean, when it comes to interest rate cuts, I think the Fed's basically ready, set, wait. And so we're just going to have to wait a while here because inflation, the last few inflation reports and CPI, just a little hot, the ECI number a little hot. So I think the message is going to be, look, we don't think we're going to have to raise rates again, but we're going to take our time about cutting rates. And they want to give that sort of generally hawkish message that they just don't have any tolerance for sticky inflation, and therefore they're in no mood to cut right now.
Kristen, so what could be the worst thing the Fed could say in its statement or in the press conference that would spook the stock and bond markets? What would be the danger word?
I think the danger would be two things. One is that inflation is more entrenched, and two, Chair Powell is going to be asked about whether a rate hike is on the table. And so anything that would allude to that, I think you would see a market sell-off. That being said, I don't think he's going to do that. I think exactly as David mentioned, this is going to be, we're data dependent. We still see the trends overall going in the right direction. We didn't have the data that we needed within Q1. So we need a more disinflationary trend to begin our rate cutting cycle. But I don't think there's going to be too many surprises.
So let's talk a little bit, if we might, about, Jim, the idea of slowing down the runoff of the balance sheet. Do you expect there to be much commentary on that? And how important is that if we do hear?
I think there will be a question on that, and that always comes up. It is important, but I think it's also very forecastable. I don't think there's going to be any surprises on that. I think really the surprise factors are going to come in terms of like what I call a crisis of confidence at the Fed, meaning that there's a crisis of inflation confidence in terms of what this bumpy path means towards lower inflation. How long are they willing to give it, or do they have to reset the inflation clock now and need to see 3 months in a row at least of low inflation prints in order for them to regain that confidence? So I think the balance sheet runoff is going to be important, but I don't think that's going to carry the day today. I think that's going to be just well baked into the news.
So David, let me come back to you very, very quickly with the same question I asked Kristen there, which is, what would be the scary words that could come out of this?
A hike. I mean, if the Federal Reserve were to say that they're thinking about hiking rates, then that would say not only that we could have higher rates, but also the Fed would be admitting that they somehow got it wrong. I don't think they're going to do that. I think they desperately want to stay where they are for a while and then cut rates this year. So the worst thing they could say, though, I think for markets would be that they're actually contemplating a hike.
All right, we're going to come back to the panel in just a moment. Meantime, let's go to Steve Leisman for the decision.
The Federal Reserve leaving rates on hold in the range of 5.25% to 5.5%. It does note a lack of further progress on inflation in recent months. The prior statement had noted that there had been progress. It says the risks to achieving the dual mandate have moved towards better balance in the past year. Note that they had said before we're moving, so that's another kind of reference to stalled progress on inflation. It repeats that it does not expect a cut until it is confident inflation is moving towards that 2% target. It reduced the quantitative tightening runoff to $25 billion from $60 billion. Pretty aggressive reduction there, and that begins in June. A way to think about this is, if my numbers are right, it's a runoff that had been going at $720 billion a year of treasuries, by the way, down to 300. It left the runoff of mortgage-backed securities the same at $35 billion. Again, that QT goes from 60 to 25 on treasuries and begins in June. That is a cap on the reduction. On the economy, the Federal Reserve continues to say the economy is increasing at a solid pace. It says job gains have remained strong. Repeats that inflation has eased, but again, noted that progress has stalled. And I'm going to repeat some statements that they repeated this time around, but maybe now they're perhaps more important. It said the committee strongly is committed to bringing inflation to 2%. They're highly attentive to the inflation risks, and they're prepared to adjust policy as appropriate if risks emerge. Those have been in the statement for a long time, and maybe now they're a little bit more important, Tyler. Back to you.
I'll give you a few minutes to dig a little deeper into those words and think about the effect of them. Let me come back to you, Jim, and we're going to get back to our panel for some reaction. We're also going to welcome in Rick Santelli and Bob Pisani. Why don't I just go to you, Rick, and get your quick thoughts?
You know, there's been some volatility in the 2-year, the 5-year, the 10-year, the 30-year, and the dollar index. But net out of the volatility, we saw up yield, down yield, but we're virtually at the same spot as before Steve read the statement. We're starting to drift a little lower, and I think that speaks volumes. Interest rates have come down from some of the peak levels earlier today, but they're up on the year, very close to some of the highs. And if you go back to the last meeting in March, we're significantly higher when we were then. I think that the salient feature here is simple. We have a stagflationary environment. Growth isn't bad, okay, but it is definitely moving a bit lower. The glide path seems to be lower, and we know that there's not only sticky inflation, there's pockets of inflation that are going up. Even though we seem to read that so quickly, nobody can hardly hear. But I go back to the same old song and dance, okay? My song and dance is easy. If you look at the last 2-year, 69 billion record size, last 5 years, 70 billion record size. The first primary auction of 10s in February at 42 billion record size. We have, what, 818 billion now to service the debt, on its way to $1 trillion, and we're at 34 trillion in debt in the U.S. We're 312 trillion debt in the globe. To me, the big feature here is sticky inflation is going to meet rising debt levels, and it's going to leave the government very little wherewithal to jockey around discretionary spending. And this all comes at a time where I know we're cutting back down to 25 billion on runoff, and also, like in Poltergeist, they're back. Buybacks are back. That was part of the Treasury announcement today. So we have QT ramping down, buybacks moving up, even though we're not easing. It's been voiced as a liquidity issue. I'm not sure. Liquidity issue really seems to be synonymous lately with rates going up quickly, but maybe they're going up quickly because spending's going up quickly.
All right, Rick, thanks very much. We'll come back to those thoughts in just a minute. Bob Pisani, let me turn to you with the equity market reaction.
Very small. S&P was down 11. Now it's only down 5. The key sentence here is in recent months, there's been a lack of further progress toward the committee's 2% inflation objective. There's the higher for longer. And the issue is, are rates sufficiently restrictive to keep bringing down inflation? That's what we're not sure of. The bond market seems to think that there might be higher rates coming. The stock market, I can tell you, is very afraid of that. Remember what happened last year when the 10-year moved towards 5% in October? The stock market fell apart. We're at 4.6. heading towards 4.7. If we go to 5, I can tell you the stock market is not positioned for a 5% 10-year yield right now. So that's a great fear. To the extent that they did not put hikes on the table or clearly indicate that, that's a positive read right now. Broader term, the debate down here is the biggest threat to stocks the fact that disinflation is not occurring fast enough, or is there a slowdown in growth? People are a little spooked by these earnings reports from McDonald's, Starbucks about a slowing consumer. My own sense is the low-end consumer is having a hard time. The higher-end consumer is not at all. So right now, I'd be much more concerned about the inflation outlook than I would be any slowing with the consumer. Guys?
So, Kristen, Rick, let's slip the word. I know it was intentional, but very intentional. A word that has been in my head for some weeks now, and that is stagflation. Is that where we are right now?
I think it's too soon. I think we have to go back to looking at the second half of 2023 and the data that we had. So when we see the third quarter and the fourth quarter, we had really strong GDP. We also saw disinflationary forces that were really, really strong and better than anticipated. Q1, you saw a little bit of normalization, right? So you saw inflation not coming down, CPI certainly not where we wanted it to be for Q1, but I would call that more normalization. Even the GDP print that we saw that came in below expectations, when you factor out imports and you factor out inventories, all of a sudden it looks like a pretty solid GDP print. So I think this Q1 was about normalization, and the data in Q2 really matters for the Fed's trajectory from here and the overall economic backdrop.
Jim Caron, the fall off or the runoff from $60 billion a month to $25 billion may have been a little bigger than some people expected. React to that, and what in a practical sense does that mean to the markets and to consumers and the general public?
Well, look, I mean, you know, I think Rick summed it up. There isn't much of a move in the rates market right now, and I think that's exactly what we should be focusing on. We're anticipating that the Fed's balance sheet is going to adjust, and I also think that a big balance sheet is a form of easy policy, so I think this does need to adjust over time. But Tyler, let me go back to what I said before, which is that this is really about resetting the clock for the Fed. When do they start to get confidence that they can actually start to cut rates? And this is the debate that's in the market at this point. So the debate is whether or not they, you know, if you go by market pricing, is the first cut in December, where many forecasters still think July. And I think the fly in the ointment is going to be the labor report. If the labor markets start to weaken, I think that advances the time scale for the Fed to start to cut earlier. But if the labor market stays strong, I think that they're going to stay on hold probably until December.
All right, so Steve Leisman, let me just get any further thoughts that you might have, having a little more time to read the statement and pull your thoughts together.
Well, I mean, I have a hard time seeing this as stagflation or in any way, shape, or form. Stagflation is high unemployment. It's high inflation. It's no growth. We are so far from any one of those three. Not that it couldn't happen, but stagflation assumes something is sort of broken in the price mechanism in the economy. And what would be broken there would be that if you do have weaker growth, prices would not adjust downward. We don't know if that's the case. I just think we're a very long way from stagflation. As for the Fed, I would say this. This statement reads to me like a plane that's circling. They're waiting for time. They've acknowledged there are a little bit of turbulence in the air there. They perhaps see some fog on the runway. So they're not quite ready to land yet, but I do think they want to land this plane. I think they're still on course to try and land the plane, Tyler. It's just that this is a holding pattern, this statement here, before the data either breaks towards weaker growth and lower prices, and or you get a move higher in inflation, which would engender a different kind of response from the Federal Reserve. But what the Fed is doing here is essentially holding.
David Kelly, let me get you to react to what Steve just said. Are we far away from stagflation? Are we nearer to it than might be comfortable for the Fed? What do you think, or is that really just not even on the table?
No, I think I completely agree with Steve. We're very far away from it. I mean, we've got unemployment below 4. We've got consumption deflated inflation below 3. 3 plus 4 is 7, but 3 plus 4 is also good. These are good numbers for the U.S. economy. Growth is slowing, but it's slowing at a modest pace. So really the economy is fine here. There's nothing wrong with the economy. It's just all a little too hot for financial markets who are banking on big rate cuts from the Federal Reserve this year. But even the statement, I think the one thing that strikes me is they could have cut the Treasury runoff from 60 to 30. The fact that they went that extra $5 billion, it probably doesn't sound like a lot, but it does say that they're trying to send a message here that they're not going to be too hawkish here. So if anything, I would regard the statement as being slightly on the dovish side, and it gives me more confidence that they won't hike again, but they will eventually cut rates this year.
I'm going to come back to all of you or several of you on a terminal question here about the terminal rate of interest rates. But Rick, let me just turn back to you for any reactions you have.
You know, to me, it's not that my sources or many people I have confidence in to gauge the future of the economy are saying stagflation's here. What they're saying is it's a rate of change argument. It's impossible to look at the GDP report and not say that growth is slowing, the rate of change is slower. So yes, the economy's fine, but it's much less fine than they thought it would be. It's much less fine than the previous quarter. And if you looked at the pricing components in the last GDP report, inflation, the rate of change is moving back up. So it isn't that stagflation's here. It's that you can't put your head in the sand. Okay, we had guidance from a dovish Fed that was very wrong, okay? Didn't hear much grumbling about that. But to have forward-looking notions regarding the glide path and rate of change of the economy that may point to stagflation, that to me makes sense, and I don't think we should ignore our eyes. Our eyes aren't lying. Things are slowing but still growing, and inflation stopped going down. You could call it anything you want, but what you can call it is a reason to ease.
How about what Rick just said? Who would like to react to that?
Well, I'll say something. Just
ahead,
briefly, just from the stock market's point of view, I cover the stock market here. The reason the S&P was down 4% in September was not because people were concerned that earnings or the economy were falling apart. The concern was higher for longer interest rates would bring down the multiple. So instead of 21 times forward earnings, we went down to 19 and change because higher for longer, of course, impacts the future stream of earnings or the perception of the future stream of earnings. Now, if there is some kind of slowdown in the economy, which we don't see yet, or the job market slows down, then the earnings numbers themselves are going to start coming down, and that's a whole other scenario.
Yeah, but Rick says we are seeing a slowdown in the economy. Rick said you got to look at the numbers; they are slower.
Here's the thing.
Jobs numbers, which is what matters, are still pretty robust.
I'm going to let Steve jump in and then Jim. Steve, go ahead.
I'll keep it quick. The idea of stag, that means stagnant. It means we're not growing. A slowing in the pace of growth is what we all have wanted. It is the soft landing scenario. So it would seem a little bit extreme to me to jump from we got the slowdown we wanted to the idea that the plane is stalling and about to crash land. Look, I think Rick is right. You got to factor that into your possibilities. I just don't think it's the most probable outcome because of what you expect to happen with prices in that scenario. In a scenario of stag, you get D, not inflation.
Well said. Jim, I want to get your final thought, and then I'll go one more time to you, Kristen and David. Jim?
So look, I think it's premature to talk about stagflation, but there's a lot of noise out there, so let's focus on the signal. Tyler, you were going to talk about the long-term terminal rate. I call that the forecastable horizon of Fed policy rates. What the market has been very stable on is that the market still believes that the Fed policy rate's going to 3.5 to 3.75% sometime by 2026. How we get there, how quickly we get there in 2024 and in 2025, there's going to be a lot of debate about that, and there's going to be a lot of noise. But what keeps the market stable, equities and fixed income, is if that longer-term forecastable rate stays stable. And right now it's staying stable despite all the confusion in the markets, and that is actually a blessing for asset prices at this point. If that rate moves higher, that could actually spell problems.
So that's where I wanted to end things. And that, Kristen, why don't I turn to you about that long-term terminal rate for interest rates. Jim just said 3.5, 3.75 by 2026. That's a little higher than we've been accustomed to over the past decade and a half, but maybe it's just not too hot, not too cold.
Exactly. I think it's higher than what we've experienced, certainly, and it's higher than what expectations are. I think since we've seen resilient growth, and I'm going to go back to something that Steve said, where we are seeing a decline in the growth rate. We're not seeing a contraction. We're seeing a slowdown in growth, which is exactly what the Fed wants to see, whether that's the data that we've seen in GDP, whether that's the data that we saw in JOLTS this morning. And so finding exactly what is that neutral rate and what is that balance is something that I think the Fed is going to take its time, and it's going to do it gradually in terms of the rate cuts that we'll see in 25 basis point increments, that if we get the data from an employment standpoint, we get the data from a disinflationary standpoint, we'll still see maybe even up to 3 cuts this year.
Mr. Kelly, you get the final word.
Okay, I do think the terminal rate ought to be higher because I think that 2.6% is too low for financial markets. But on the state of the economy, I know the numbers are getting a little worse on inflation temporarily, but that's kind of like saying, a teenager gets older every day, doesn't make them old. And so this economy is really much more like a teenager than an 80-year-old right now. It's an economy which is showing plenty of potential for growth. Inflation, I think, is still sticky, but probably trending down. Unemployment is very low. This is actually a pretty good economy for Main Street, not quite as good for Wall Street if you really want short-term rates to come down to 2.5%. But frankly, I think this is a glass, not just half full. This is a glass about 80% full here.
All right, that wraps our conversation. Thanks to our panel. Lively conversation. We stirred the pot a little bit there. Thanks so much to all of you for your participation today. Really appreciate it. All right, coming up, we will get more reaction to the Fed leaving rates unchanged. We're going to get reaction to the Fed doing nothing. No, that's just a flippant way of saying it. We're minutes away from Jerome Powell's press conference. There, you will get a real chance to hear the thinking behind the Fed's actions today, or non-actions. We'll take you live, but first, a quick break. All right, welcome back. Let's get a little more reaction to the Fed. Rick Santelli is back. I feel a little guilty, Rick, for maybe putting words in your mouth on stagflation. But the essential thought was really whether we're at stagflation now or not. Your thought was, and I want you to elaborate, was the idea that you've got growth slowing at the same time that the decline in inflation is abating and maybe moving back up. And so it may be a low probability that we get to stagflation, but you can't dismiss it out of hand.
No, listen, Tyler, there was a lot of ifs and maybes that our guests put forth, okay? Maybe this will happen. I'm a numbers guy, okay? I look at the numbers, the hard data. GDP in the first quarter was 1.6. In the fourth quarter last year, it was 3.4. That is much slower. And if our guests say, well, wow, 3.4 was too strong, I understand that. But what was the consensus call? 2.5%. We got 1.6. I'm a numbers guy. That's slowing. And if we look at the GDP price index, it was 3.1, okay? Last look, it was 1.6. And the core was 3.7 versus 2%. There is no denying the hard numbers. Now, we could question whether the numbers the government puts forth are accurate, and many who look at the labor markets don't think it is. But I will go with the numbers. I don't like changing midstream. So it could be a consensus call that stagflation's a low probability, but it's a significantly higher probability than it was a month ago and much more significantly higher than it was a year ago. And once again, the guidance from the Fed has been very wrong. People want to blame the markets. You could say dot plots, you can point to anything you want, but even the Fed chief Powell has had a lean towards move. They still have a lean. The question isn't whether they're going to ease, it's that they're going to ease. But what if inflation goes to 4.5%? So I'm a hard numbers guy, and the numbers do not back up most of the conversations I hear.
Well, he will certainly be asked, won't he, in a few minutes' time, in about 8.5 minutes' time. He will certainly be asked whether there is a possibility that inflation resurges and he has to raise rates.
Yeah, you know, that's not my base case. And to be frank, my base case isn't necessarily stagflation. But I think that if you have a runway long enough right now to consider all the moving parts, I cannot dismiss how debt is a growth killer. And it's not only domestic, it's global. And it's only going to get worse. Even the IMF's numbers have some global growth kicking up a little bit, potentially in the next 12 months. But if you look at their longer-term prognosis, debt is going to dwarf growth, and it's going to be like an anvil on top of the shoulders of growth.
Well, I worry, too, about the volume of debt that we've added to the economy, and now at higher interest rates, how much more we're having to pay to surface that debt. Let me come back, though, to the stagflation discussion that we had in the prior block. If I discerned from sort of that panel's discussion that it was that, well, yes, the economy is slowing, inflation may be sort of plateauing, but this is the soft land. This may be the soft landing that everybody was hoping for. How do you react to that?
You know, I just think it's too early to tell. I can't tell if we're going to have a soft landing. If we get a CPI that moves up significantly, soft landing could go out the window. And it isn't only about the soft landing, just your discussion about what the terminal rate needs to be. There's no way to really tell what the terminal rate needs to be. There's no way to tell what it will be. So some of these variables that are so intricate in plugging into the Fed's models are just assumptions, and we really don't know. And anybody who's looked at how many variables, the Wall Street Journal did a report on this. I forget how many variables are in the econometric model that the Fed uses, but there's a boatload. And I'm not saying that it isn't the best model on the planet. I'm just saying that we don't know how much air we're going to have, and a little bit of air in the marketplace has a huge distortion when you move 2, 3, 4, 5 quarters down the road.
Tell me I'm crazy, Rick, which many people are more than willing to do, but about this sort of assertion. Neither the Fed nor the Fed futures market have been particularly good about predicting what's going to happen. The Fed was talking about transient inflation for a long time before they took the word transient out of the conversation. Now the Fed basically is saying, well, we're going to be ready to cut rates, but now maybe not so soon, not so fast. The market, similarly, last fall, thought there would be a lot more rate cuts coming this year than the market says today. So who's the good predictor here of either what the Fed is going to do, what inflation is going to do, what the economy is going to do?
You know, Tyler, if I tell you that the Chicago Cubs are going to have 3 pitchers that are going to win 30 games this year, you'd probably raise the chances of them going farther down the season and doing better potentially and making playoffs. Well, what if the pitchers don't win 30 games? See, here's the issue with those predictions, is that the market is listening to the Fed. The whole premise of Fed guidance is to guide the market by the nose, okay? And when you still have a huge balance sheet, when you're still tinkering with rates, how can the market actually rise to the occasion and accurately price risk? In my opinion, 4 weeks ago, you did not see an ease in today's Fed meeting. That's what the Fed contract is good for. And anybody who thinks that looking today is going to give you an accurate picture of July, Sep, Nova Ds, and Fed fund futures, I think they're misguided. It really is for the next meeting and only when you get within 4 to 6 weeks. And if you look at that as the criteria, the contract's almost infallible. What we are looking for that contract to tell us is impossible, okay? And just because traders are putting their money there, it isn't that it's wrong. It's so the Fed is positioned them that way. And in addition, the Fed fund futures contract and options in large part may be a hedge. And the hedge doesn't necessarily give you the entire picture.
So what I'm hearing you say there is that the market in its predictive value is kind of like a long-range weather forecast. It's going to be a hell of a lot more accurate predicting what's going to happen tomorrow or a week from today rather than what's going to happen a month or 8 months from today, correct?
Bingo, you nailed it. That's it.
On that, if I get an A from Professor Santelli on anything, I appreciate it. All right, Rick, thanks, my friend. All right, let's get some final thoughts as we count down to Fed Chair Powell's press conference. Mike Santoli joins us as well as David Kelly. David, why don't you kick it off? I don't know whether you heard the last part of that conversation. I asked Rick fundamentally, who's the better predictor here of what rates are going to do, what the Fed is likely to do, the Fed or what inflation is going to do, the Fed or the markets, or are they both equally wrong? Equal amounts of time.
Well, I think you're both spot on that it's like predicting the weather, 10 weeks out. But investors should invest
What's
based
up, traders?
on the climate, not the
What
weather.
is
And
up?
we've
Happy
generally got a
hump,
good
dude.
economic climate here. We've got a climate which seems to allow steady economic growth.
All right, guys, I'm going to put the
Fed
Fed
will gradually moderate as it did for many
the
decades
Fed thing
before
on.
the
Hang on a second here.
pandemic. And the unemployment rate seems to be
All right,
pretty
spy-
low, and
spy
workers that
pumping
don't
here,
seem to be
15-minute chart, should be
demanding
5
huge
minutes.
wage
What the hell's
increases. So
going
the
on here?
climate's pretty good. The
A little
weather's gonna
climb
bounce
here,
around,
breaking
but
low of
long-term
yesterday
investors,
and
shouldn't play the
pre-market
trading
high.
game here. They should invest based on that climate, which, as I said, I think is pretty positive.
Good wisdom
Oh,
there. Mike Santoli, your reactions to the Fed decision and what we might expect to hear from Chair Powell.
Yeah, clearly the market is taking it as the Fed electing not to turn more explicitly hawkish. There was perhaps some idea that it might do that. It just acknowledged the data that's happened in the 6 weeks since the last meeting. And of course, in those 6 weeks since the last Fed meeting, 2-year yields, 10-year yields are both up.
FOMC is
40
strongly
basis
committed to
points or
returning
so.
inflation
So there's
to
been some
2% target.
market, tightening of financial
All right.
conditions.
What's
The
up, traders?
the
What's
Fed
going
wants to
on?
preserve
Happy
optionality,
Hump
keep
Day.
its options
Shit,
open
hold
as
on.
it usually
You
does.
guys wanna call
and
me?
that does mean being
get on
data
the air and talk
dependent.
some
So
smack.
I think that's sort of better than we
Taquito,
could
what's
have
up,
feared,
dude?
perhaps, and from the market perspective. The issue to me is the bond market has implicitly been testing the
Taquito, man,
economy's
thank you, man. You're
tolerance for
probably
higher
right, dude.
yields
Like,
as the
off
Fed has
the
been
air or
testing the
something like
economy's
that. I
tolerance for
get it,
higher
Taquito. I
short-term
get it,
rates.
man.
So
I'm
far,
sorry,
it's been
man.
okay, but we're searching
Sorry,
for this
dude, I
new
got busy.
equilibrium out there, and I do
I
think
know.
that in the press
We're here, though,
conference,
baby.
what
We're
the
here. We
market
live. We're feeling
would
this
like
gap. Here we
to
go.
hear is that Powell still thinks you can have inflation continue its decline without undercutting economic growth. That was the main premise of the December pivot. And if he sort of goes back on that and starts saying, well, maybe the services sector really does have to be restrained more to get wage growth down, and I don't think the market wants to hear that there's going to be that economic cost for a resumption of disinflation. I also think they want to hear him point out that PCE inflation is not terribly far from where the Fed thought it was going to be by the end of this year at the latest reading. Remember, there's no dot plot in this meeting, so there's none of that he has to kind of dance around in his response.
Quick final thought, Mike. The Dow, and maybe peculiar to the Dow, seems to be reacting in a rather sprightly way. It's up 200 and some points right now.
Yes.
Go ahead.
I was just going to say all the indexes did actually get a lift on the
we got a little
statement.
lift
Of
here,
course,
guys. Boom, boom,
Fed
boom.
day reactions sometimes can really be very much a quicksilver type of thing. You don't know if the first move is the right move, but I do think that's because there was an absence of incremental hawkishness. Plus, you had that further decline in quantitative tightening, perhaps beyond what people were projecting.
Yeah, and of course, David, I asked him what the trigger word would be here, and he said hike, anything having to do with hike. And so, David, you were right there. That word has not come into play yet. It will be interesting to see, however, how the chair handles questions about whether an interest rate hike was even discussed in their meetings.
Yeah, he's going to have to play that one very carefully. I think he'll have to admit it's always possible to raise interest rates, but their base case is still just about the timing of rate cuts, not the option of hiking rates.
And your base case, sir, just once more for the record.
At the moment, 1 or 2 rate cuts, nothing before September, maybe nothing before December, but some cut this year.
Let's go to the chairman of the Federal Reserve, Jerome Powell.
To our 2%
All right, here we go. Enjoy.
Price stability is essential to achieve a sustainably. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. Unchanged, and to continue the economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained on economic activity. And that's very good news. And the risks to achieving inflation is still too high, and inflation goals have further progress in bringing it down over the past year. And the path forward is uncertain. In recent months, inflation has shown we are fully committed to returning inflation to our 2% goal.
They say that
and
every
we
time.
remain highly restoring price stability is essential to achieve a sustainably strong labor market that benefits after briefly reviewing economic developments. Today, the FOMC decided to leave our policy interest rate unchanged. Economic activity has continued to reduce our securities holdings, though at a slower pace. Although GDP growth moderated from 3.4%, our restrictive stance of monetary policy has been putting downward pressure on economic activity. Private and domestic final purchases, and the risks to achieving our employment and inflation goals have moved toward better balance. Usually sends a clearer signal on underlying demand. However, in recent months, inflation has shown a lack of further progress toward our 2% objective in 2023, and we remain highly attentive to inflation risks. Consumer spending has been robust. I'll have more to say about monetary policy after briefly reviewing high interest rates have weighed on housing and equipment investment. Recent indicators suggest that economic activity has continued to expand at a solid pace. And the strong performance of the U.S. economy, although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, but supply and demand private domestic final purchases, which payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. From financial markets. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. Until at the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing consistent with the committee's intention to hold primarily Treasury securities in the longer run. We're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion stage for achieving maximum employment and the decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than what our actions affect, but rather allows us to approach its ultimate level.
Are we going to do a pump here?
Everything in particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves.
Howard Schneider with Reuters.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices. Pretty clearly over the policy is restrictive and is weighing on demand. To conclude, we understand that our actions affect communities, families, and businesses. You can start with the labor market. Everything we do is in service to our public mission. The demand side of the labor market in particular. We at the Fed will do everything we can to achieve our level of maximum employment and price stability in job openings. You saw it. Thank you. More look forward to today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized.
to get inflation
I
back to
also
2%.
we look at surveys. I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. Jobs plentiful and there's a few places I would point to for that. Easy to find workers. You can start with the labor market. The answers to those have demand is still strong. The demand side of the labor market in particular. You also see, but it's cooled from its extremely high level a couple of years ago, and you see that. You also job openings. You saw interest rates more evidence of that today in the JOLTS report, as you'll know. I do think it's clear. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and the JOLTS report. So that's demand. I would say the same is true of quits and hiring rates, which have essentially normalized. Restrictive. That will be a question. I also look at data. We look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those. I don't want to get into activity. So I do think it's clear, but I would say that policy we're committed to retaining our current restrictive stance of policy for as long as it's appropriate, and we'll do that. We believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been,
Michelle
the
Bowman
job
has
market
been
stays
saying that there is a
reasonably
risk
strong,
that rates may need to
unemployment
increase
low, and
further, although it's not our
expectations
baseline
are
outlook.
anchored and
I wonder
maintained.
if you see that as
Would
a
you
risk as
disrupt
well,
that
and
for
if so,
expectations are
what
not
change
anchored? Or
in
anchored.
conditions
Or
would
anchored.
merit
Stable,
considering raising
roughly.
rates at this point?
Would you disrupt that for the
I
last
think it's
half point
unlikely
on PCE?
that I don't want to get into rate move complicated hypotheticals, but I would say that we're committed to retaining our current really what I just mentioned, which is policy for as long as it's appropriate, and we'll do that. You ask what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring
Thanks for
inflation
taking our
sustainably
questions,
down to
Chair
2%
Powell.
over time.
I wonder,
that's not what we think
obviously,
we're seeing, as I
Michelle
mentioned.
Bowman
But
has been
that's
saying
something
that
like that
there
is what
is
it
a
would
risk
take.
that rates
We
may
look
need to
at the
increase
totality of the
further,
data,
although it's not her
answer that
baseline
question.
outlook.
That would
I
include
wonder if you see that as a
inflation,
risk as well,
inflation
and if
expectations,
so,
and all the
what
other data,
change
too.
in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. What I'm saying is, if we were to come to that conclusion, our policy focus is really what I just mentioned, which is how long to keep policy of all the things we're be looking at. You ask what would it take? I think we need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time for us to. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data, too. Well, I think, again, the test, what I'm saying is, if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on...
all right, we're pumping here.
Let me address
just hit the top of the daily range, 505.66 on the SPY.
Our decisions that we make on our policy rate are going to depend on the incoming data, how the
Plus
outlook is evolving, and the
36.91
balance
on
of
the
risks,
S&P
as
500.
always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening in the labor market, for example. So those are
major
paths
volume
in
coming
which,
in here. We're pumping
which
hard.
You could see
approaching
us,
the high of yesterday,
cutting
510.
rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We
getting a nice pump here across the board. Everything's pumping. Snaps new high 1603. AMD up, trying to recover up down pretty nasty after the earnings. Tesla
like to see
up $1.84. Things are looking good.
We also want to see them not eaten up by high inflation, and that's really what we're trying to do is to cool the economy and
what do you guys think
with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. You know, what we said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be
forming a little bit of a bull flag here, immature bull flag on the SPY. 506 or 45 on the SPY right now.
Are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market.
Don't forget to subscribe to the show here on TradeCaster and on YouTube.
Three inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path than a 2% inflation. That's the signal that we're taking.
And Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably on 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Is this the real move, though? Is this the real move, though? We sucking in. Is this a bull trap?
Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Joe Powell's got jokes.
The vice chair of the FOMC said recently that he's willing to
still
consider
pumping here,
the
guys.
idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. I mean, the question is, will productivity run there are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means.
All right, during Power Hour, guys, we're pumping into Power Hour.
Next year.
If you are long,
and
stay strong.
Too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, you've got more supply.
Good luck,
but those
traders.
people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Power Hour, baby.
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has been on
Bitcoin recovering here, 58,995, almost 59,000.
Holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico.
Victoria.
You've talked about your commitment to being
snap,
apolitical and
pumping
nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election?
Yo, let me know if you want to call in. Let me know if you want to be the first one to call in. I'll give you a number to call. We'll give it a test.
Economic difference between
I ain't messing around, for real. We'll do it during Power Hour.
In say September
Let us
versus
know.
December.
Let us know you want to call the show.
So we're always going to do what we think the right thing for the economy is. When we come to that consensus view that it's the right thing to do for the economy.
We'll get you on the air live here on the spread, hanging out with Shimano Trader. What's up?
Anything else? It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and
everything
use that
pumping
as a
and
new
Apple's
filter,
up too,
it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing. And we'll all do that. And that's how everybody around here thinks. So I can't say it enough. We just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where
A
we're
little
serving
blow
all
off
the
top here,
American
possibly
people
on the SPY.
and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Starting to pull back a little bit here. Got a high of about 508 on the SPY.
Question about the labor
testing
market.
high
You've
of
mentioned a few times that
yesterday.
the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic.
A little bit of a
I
pullback
wonder if
here,
you can
but
share your
VIX
analysis of why
dumping.
that's happening. Is it a lagging indicator or something else going on?
Tokido should have shorted the VIX,
If you
baby.
go back to where wages peaked, wage increases peaked a couple, 3 years ago. Essentially, all wage measures have come down substantially to that. But they are not down to where they were before.
Even Boeing's up 3.25%, almost $6, 550.
And we've seen
Amazon's up to $8.49, 4 or 5, almost 5% on
the ECI
Amazon.
reading from Tuesday was expected to be
Everything's
to
up,
have
guys.
come down, and
As
essentially
long as
it was
bulls are
flat
back in
year over year.
charge.
I think roughly. So, yeah, I mean, it's that part of it is bumpy. And again, we don't target wage increases, but it, in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Sounding very dovish here, Mr. Powell. Most people got it wrong again.
Nancy. Sorry. Hey, Chair Powell, Nancy Marshall from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8, now it's at, anyway, headline peaked at 7.1, now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets, at least, have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may
higher
go
for longer,
that.
guys.
In terms of the implications,
that's the
I think.
Yo, don't forget to subscribe to the show here on Tradecaster, also on YouTube.
Thanks
for hanging out with us today.
So I think.
Shout out to Toquito holding it down in the chat room. What's up?
And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
I don't know. Let's check it out.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain.
You're shorting, Neo? Is that what you're doing?
Back down. But given sticky inflation data in the
Maybe
first
cup and handle
quarter,
here,
can
maybe
disinflation still happen
If anything,
along a
I'd be long
relatively
here. Just a
painless
quick
path
glance.
for the
I see a little
economy,
cup and handle here in the
or
5
is some
minutes.
softening in the labor market and the economy
FYI
likely
here,
needed to bring
look
inflation
like a little
back
cup
down?
and handle there.
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode.
You're shorting it
That
just
didn't
today?
happen. That's
Is this a
a
swing
tremendous
trade,
result.
day
We're
trade?
very,
You're trying to
course,
short before end of
gratified and
day?
pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply problems, supply side problems.
You do minute charts, though. You do 1 minute charts, right?
Issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so, we're trying to use our tools in a way that
caught this move here,
keeps
possibly,
the
right?
labor market strong and the economy strong, but also helps bring inflation back down to 2%
I see. You
sustainably.
caught
We
this
will
move
bring
here,
inflation
possibly.
down to 2%
That's what you're talking about.
sustainably. We
Same
hope we
level?
can do it without
kind of in the same level here, right?
without,
I see what you're saying.
significant dislocations in
Yeah,
the
and just
labor
looking at a
market.
little
We're
blow
also-
off top.
And speaking of dislocations in the
Hey,
labor
not
market,
financial advice, not
in terms of
recommendation, right?
cutting,
You will
you
lose
said
money.
if there were weakness in the job
say stay
market, that
short.
could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment
Fuck it, stay
rate
short, bro.
popping back
I would.
above 4% catch
Let's
your
do it.
attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that.
I see what you're doing,
it
though.
would be-
Now,
it'd have to
you
be
explained it really well, that you were in the
meaningful
same
and
level when
get
you
our
caught this
attention
move here.
and lead
You're
us
at
to
this
think
kind
that
of
the
the same
labor market
spot.
was really
Yeah, I'd stay
significantly
short.
weakening for
See if
us
it
to
makes
wanna
another move
react
to the
it.
downside.
A
It's
couple of
just
tenths in the
basically
unemployment
looking
rate
at the
would be-
chart fresh, no bias,
would
just
probably not
straight
do
looking at
that.
the chart.
A
I'd stay
broader-
short
would
here.
be a broader
We've got a
thing that would-
rejection
that would
here, another
suggest
rejection
that,
here. I'd stay short.
That it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all
Okay,
the
so that's
facts and
my
circumstances, not just
analysis
that
here,
one.
sir. 5 minute. Let me see. Yes, that's 1 minute. 5 minute.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker.
Yeah, you're about to
You
lose the
said
EMAs
that
here on the
broad
5
material
minutes. You're about to
changes
lose
are
the
needed
EMAs.
for the Basel III.
Yeah, you might flush here, end of day, man.
proposal, And you've mentioned that a reproposal
Right,
is
let's do it.
something that's on the table. As you've had more time
We'll keep it on the
to
chart
sit
here with
with
you,
the
Neil.
public commentary,
I caught you,
process
Neil. We're gonna
that,
stay-
and understand the
keep Neil on the
options
chart here.
available to you, do you have a better
All right,
sense
let's
of
do it.
whether
See
a
what happens. Leave the
reproposal will be
5 minute chart.
necessary?
It looks really good on
and
the-
do you have
on the
a
1 minute.
timeline in mind for when
There you go. You're starting to get
some
it
sort
right
of
there. Lose
movement
the
will be
EMAs here.
made on that front, either
Yeah.
a reproposal or a move
All right,
to
let's do it.
finalize?
45 minutes to go.
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable
Snap
jurisdictions
pumping
are
today,
doing.
man. Up 7.5%,
We haven't made any
up
decisions
16.20.
on
Looking good there
policy
since
or
the
on process at
since
all.
earnings.
Nothing. No decisions have been made. I'll say.
All right,
again, though,
we're cheering
if
Neo
we
here.
conclude
We're
that
cheering
that
Tokido with
proposal
Neo
is
short.
appropriate, we
See if we
won't
can flush end of
hesitate to
day.
insist on that.
Got a
And then do
Fibonacci
you need to
retracement on it.
resolve
I'll leave the
issues
5 minute
with
chart here.
the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to
All right,
make
528,
progress on those
522.
other agenda
First
items?
target.
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Go to Mark for the last question.
Last question for Mr. Powell.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman,
sorry.
what can you tell us about the approach that you take with your
Looking
role
good here
in
on
the
the
sense
short.
of trying to achieve consensus, which you recently identified as a priority, while
we got your first
allowing
target,
for a
528
range
right
of
there.
views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC,
1 minute.
you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the
All right,
great
we lost all the EMA
aspects of
support
the
lines here.
Federal
I'm looking
Reserve
good for the
system.
short.
We have 12 reserve banks around the country where they have their own economic staff, not the
Running
people
out
who
of
work
time,
here at the
too.
board. They're different people, and so each reserve bank has its own culture around
Oh, got a
monetary
break here.
policy and its own
Got a
approach
break on
and
the
that
1
kind of
minute.
thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent
Holding on to 5
is a good thing. If someone really makes you
I gotta
think
put up.
that kind of thing.
I gotta do a 2-minute chart.
But all I can say from my standpoint is I listen carefully to
heard people
people.
have a
I try to
specific thing on
incorporate
2-minute chart,
their
like there's
thinking,
something about a
or do
2-minute
everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not.
All right, guys, don't forget to subscribe here. We're riding Tokido with his trace short on Neo. See if we get a flush end of day. Targeting 528. See if that happens. We're getting a break here on the downtrend, though. So.
I mean, I think we have a very
on the,
diverse
on the
group
support,
around
on the
people,
resistance
frankly,
here,
more
on the
diverse
resistance.
than it
See
used
if
to
that
be in
holds.
many dimensions, more diverse from
We just riding with them.
obvious, gender and demographic ways, but we have.
Don't forget to subscribe to the show here. We're getting a little dump. There it is.
And law and academia and things like that. So I think you actually do have
that
quite
looked
a
great.
good
That looked
diverse
really good.
perspective. I think all of us read these stories about a lack of diversity.
I got the last
We look
question here
around
from
the room
Powell,
and
and
say,
then
I don't
CNBC
understand- I
gotta
really
jump
don't
on.
understand what they're talking about. So, but I get the question.
About 40 minutes to
Thank
go.
you very much.
Power hour.
And welcome to Closing Bell. I'm Scott Wapner here, Post 9, New York Stock Exchange. And as we hit this final stretch, seems pretty clear the markets did not get the more hawkish Fed chair that it had feared and
Wrong
perhaps
again.
even prepared for in the days leading up to this moment. Though Chair Powell cited a, quote, lack of progress on inflation in recent months, he said longer-term inflation expectations remain, quote, well anchored. He said he still expects inflation to move down as the year progresses, especially
All right,
in
got the next candle here in the 1-minute chart. Looking very bearish on Neo. See if we can hold this downtrend here, this resistance. Whoa, nice.
We check the markets now. Clearly, the market's taking this as a bullish event today.
We're gonna hit that 528, man. I think we'll hit it.
There, almost everything is higher by at least 1%. Interest rates coming down a touch. No surprise that you would see the Russell 2000
Bitcoin
doing
pumping
quite
too.
well.
Bitcoin 58,298, 58,298. Got a little bump down. Bitcoin, major fall there.
So let's bring in Jeffrey Gundlach.
All right, we're
now.
going to leave the
CEO,
CNBC in the background
CIO,
there.
Co-founder of Double
We're watching
Line Capital.
Tokido's trade here.
Jeffrey,
See if
it's good
staying
to see
short.
you.
528 is the
Welcome back.
target. First target. See if we can get that.
Nice to be back on Fed Day, Scott.
Yep, and it's good to have you. First and foremost, your reaction to what we just saw.
Well, I think you just said the most important word, which was unlikely. Unlikely the next policy move will be a hike.
There it is. New
And
low.
He went quite
Continuing
out of
the
his
lower
way
low. Lower
to make it
lows.
sound like they're not contemplating a hike at all based upon the data that's come out, even though he's being a little bit disingenuous by claiming that inflation is below 3%. Remember back
Called him a liar, bro.
at Jackson Hole in 2022, I think.
What's
it
up?
was,
What's up? If you're in the chat,
he
jump
came
on
up
this
with
chat.
Supercore inflation, supercore
Let me know what you thought of
CPI,
FOMC today.
supercore
Were you well
PCE,
positioned?
and
What
supercore
happened?
PCE,
Yo, shout out to
which is
Tokido. We're riding this
excluding
straight down to
food,
528
energy,
on
and
Neo.
housing,
We're short
is
Neo
up
here.
3.3%
Taking his
year-over-year. And,
taking his
what
short
no one
here.
wants to talk about is
50%
supercore
retracement is
CPI
509.
Is up 4.8% year-over-year.
But this
In
is
fact,
the 1-minute chart. We'll put the 5-minute chart here. Getting another little dumpage.
Here in 2024 at
Tokido looking good. Look at that 5-minute candle, man. That's very bearish. Nice. Whoa, that looks good, man.
Instead, it's 3.5
Good call,
year-over-year
man. Look at that.
on the headline.
Looking to sell
So
half at
it almost feels
528
to
is
me
what he
like
said last.
he's
Want to look at
hoping
what we said
that
was in the chat.
inflation data comes down without a rate hike. And I guess he feels that the lack of progress, as he framed it, during the first quarter is going to be transitory. So we'll see. With oil prices at $80 a barrel, I'm not really sure we're going to see the inflation numbers come down in a sustainable way.
Yo,
below
good stuff
3%,
here, man.
Particularly not on the core numbers. So
Yo, don't forget to subscribe to the show here on Tradecaster. We're also dual streaming on YouTube.
There was fear of a lurch toward.
Just finished listening to Jerome Powell, looking very dovish. Everybody thought it was going to be very hawkish, but he wasn't hawkish at all. So, but we're holding longer, higher for longer on the interest rates, higher for longer. Oh, get a little pop here on Neo.
Junk bonds went up a lot.
Ooh, waking up, waking up.
Bonds and emerging
Alert,
market
alert,
bonds
alert.
down earlier in the day, and they're now significantly in the green. So this is a interesting thing because the big pivot that started everybody getting happier was November 1st. And interestingly, rates are up a little bit since then.
Dan, look at that bid and ask, man. That's huge.
Basically had
Look at the
rates go up
orders
and
on the
then
bid
come
and
back
ask on
down
the
and
level
go back
two.
up again. We've
Hey,
definitely
man,
been
this is
in a
this
trading
clapped
range
here.
for the fixed income markets and
Be
more
careful if you're
recently,
short here.
sort of
The
the
big
equity
break here,
markets as
nice big
well.
candle.
And this meeting and this press conference suggests to me that that's going to be sustained.
It certainly sounded like I guess we could say, a not yet chair versus a not at all chair, at least when it comes to rate cuts.
Yeah, big volume coming in on the
going
bid,
in
man.
that
The bid side, level
Goldman
2.
is still sticking to its view of 2 cuts because they say the 2 pillars of disinflation are intact, those being lagging housing data and the fact that we don't have any more supply shocks. I'm curious as to what your take is now. When do we get the first cut, and how many will we get this year?
All right, good. We're holding here. We're holding here. Tokido's holding. Live trade here on the air with Tokido.
I actually, based on
shorting Neo here into the close.
Market, and commodity prices, which have been weak recently.
Now we got above EMA lines here, man. I think that's long here. Caution, caution.
Base case now
alert.
For this year,
cut.
and I certainly don't think it's.
You mean cut?
Sorry, yeah, cut. Yeah.
Freudian. It's a Freudian slip.
got it backwards. But I don't think it's coming in June. I just don't see how that could possibly happen.
Next support 530.
There's just not enough data, and he certainly respects the fact that, I mean, lack of progress on inflation. That was not unanticipated that he would say that, because you can't disrespect the data. I mean, it is what it is. But I thought one interesting takeaway that I got was he mentioned that a couple tenths in the unemployment rate would not be a catalyst for easing. I had the feeling that he needs the unemployment rate to get up to 4, maybe 4.2 even. And so we'll see what happens there. The unemployment rate has.
Yo, what's up? You in the chat? Say what's up. Where you repping us from? Tokido checking in from Lithuania.
Inflation fight is less important.
All right, so we got the push here, man. That candle here. Whoa, careful here.
Because the jobs part is behaving quite well, and the inflation rate clearly is the one that is lacking progress, as you put it. So I'm going to lean on
1 minute chart here,
rate
guys.
cut this year. I certainly don't think 3 seems very likely at all. So that's where it is. I think that higher for longer seems like the mantra continues, but without a rate hike. So this is a pretty good environment. The type of strategy that we've been advocating and implementing seems like it's going to keep working. It's been working really
Amazon
well
almost
for
up
the past
almost
6 months.
$10
And
today,
that is,
5.7%.
you can get pretty good yields by investing in securities in the fixed income market.
S&P up 51.34. We're about 10 or 6 before FOMC. Up 1%. VIX 14.56.
That are priced off of
new
the
weekly
short end of
low,
the curve, or say off the 2-year or the 3-year part of the curve, where you can get yields that are in the mid-7s without a lot of risk. And that seems like it's going to be a very comfortable place to invest without a lot of volatility. So you want to take advantage of this inverted curve,
man.
which has
After
been
this candle, I
inverted
would have jumped out
for a
right this
very
candle if I
long
was
time now.
short.
It's one
But
of the
let's see, man.
longest
You've got it.
inversions,
You've got it.
In the history of the bond market in modern
Tokido.
times. And it looks like it's going to continue for a while. So that means that you
All right, what's up? You new to the show? Thanks for stopping by. Don't forget to subscribe here on Tradecaster. We're also dual streaming on YouTube. Thanks for stopping by. We're a live trading show. And
really
I'm Shimano Trader. Thanks for being here.
So we've liked bank loans in the double B area. They continue to do well. We like consumer receivables, parts of the
All right, went to Power Hour. We got about 30 more minutes to go. And it is over.
Can all generate.
What we got today?
7.5%,
What's on earnings
8%,
today?
Depending on how much risk you're willing to take. And once again, with some uncertainty having developed, maybe it's going away now with this Fed meeting today, but for retail investors, closed-end funds have gone back to trading at discounts broadly.
I got
and
Etsy
with some
after the
leverage
bell
involved
here.
There's double-digit yields available
Paycom,
without
Carvana,
taking a ton of credit risk.
First Solar.
So this seems like a pretty good
and
environment
Qualcomm.
for moderate risk assets, and it seems
Apple
like
tomorrow.
We should probably not have
Fortnite.
a terribly volatile environment for the next Fed meeting, which I know you're coming out to Double Line for the next Fed meeting. It'll be
Big
fun to
Apple
do it in
tomorrow,
person.
Thursday after the bell.
I'm looking forward to that. What about the shorter end of the curve? Maybe the belly of the curve, even if you think that, I mean, Powell's all but telling you without saying it that they think the next move's a cut, right? I mean, they're pretty much alluding to that. It's just a matter of when. So if you think that rates are going to go down later in the year, what about
look at that Neo holding here.
Well, I don't really like the long end of the Treasury curve right now.
Oh, Tokido holding through this spike.
Treasuries, they rallied a fair amount from October, and now we're more interested in, say, the 10-year than the 30-year Treasury. and liking the belly of the curve, as you say, pretty well. And pricing and assets that are priced off of the 2-year and the 3-year, you don't have to go into junky credits. You can get the yield of the high yield bond market to a no default scenario, basically in single A securities that are priced off of the 2 and 3-year part of the curve. So that's what we really like. We haven't had a lot of changes in our portfolios since last we spoke, Scott. We've shortened our duration a little bit because we thought rates were a little bit too low and the 10-year got into the 3s, as we suspected was going to happen. But now that we're up at 4.6, and well, we lost the 5 handle on the 2-year after the Fed meeting, but those are pretty attractive returns for the risk that you're taking, and the volatility just hasn't really been there. Since November, the volatility in the bond market has pretty much dissipated. I mean, a couple of years ago, rates were 200 basis points lower than they are today, but they've certainly plateaued. I mean, we're basically, in many parts of the curve, very close to where we were.
Nice holding here. Tokido, you still holding here?
For the past 6-7
Looking
months.
good here. Nice rollover
so
here.
It's a low-risk environment, and it's appropriate that we got a big equity rally because everyone was scared that, the Fed might mention a rate hike. And that absolutely did not happen. So I think we have to characterize the Fed today versus expectations perhaps yesterday as being incrementally dovish.
I'm going to come back to you in just a second, Jeffrey, because on that note, Steve Leisman's out of the room now, and I quickly want to go to him. That really is the takeaway, Steve, right? An incrementally more dovish Fed chair than I think the market was clenched up in fear of.
Yeah, I think there was probably some pricing, Scott, for a Fed that was maybe, more
so your
likely
stop
to
loss
talk
is
about rate
545.
hikes, and that's not the
great.
case. And I think it was
Nice, staying
critical
patient.
when
Nice.
Powell answered my question and said, you know what, I still have confidence in inflation coming down. Let's listen to that.
My expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen.
So the idea being that I think, as you said earlier, Scott, he said the next move being a hike is unlikely. It means rate cuts are still possible. I think it's worth talking about, Scott, when you asked Jeff about whether 3 cuts this year are likely. Well, we're in April now, right? So,
all right, we're going to shut this off, get back to some music.
So that question is
Powell, very dovish. Market was pumping. Neo's dumping here, holding Neo here. Let me just check SPY real quick, see if we've given it all back up. Oh, look, SPY's giving it all back up. We got as high as up this little block up here, and then we started selling off, breaking the high of the daily range, purple lines of daily range here on the SPY. 505 to the high side, 498 to the downside. Let me shut this full up real quick.
Right now, in terms of.
All right, so we're going to get to the music. All right, seeing SPY dump here at the close. We got as high as about 508.36 or so on the Powell. As always, the first move is not the last move. Starting to roll over on the SPY. Going back to Neo, we got a live trade going on here with Neo. With Tokido, who is holding a stop loss 545. He's short on Neo here. Starting to get really big dump here. So let's go. Let's go. All right, guys. Power hour. Most likely, we're going to roll over and take a dump. Wherever you're at, wherever you may be, happy hump day. Thanks for hanging out with me, Shimano Trader. Follow me on Instagram at Shimano Trader. Don't forget to subscribe to the show here on Tradecaster. We are a live trading show. Just hanging around, talking it up, trading, seeing what you beautiful humans are out there risking your daily life every day in the markets. Putting your money on the line, trying to double it up, trying to make 20, 30, 40, 50%, 100%, 1,000%. Love and respect to all you guys out there showing up every day. What did Random Trade said? He said, shout outs to all the he said shout outs to all the break-even and losing traders out there showing up every day. Showing up every day to the market. Put it in some work, baby. Put it in some work. It's the only way, baby. It's the only way. You gotta put in the work. Oh, level 2 is stacked. Is gonna, yeah, that's an interesting call out, dude. I've never seen this many share. Like when I look at the SPY, I've never seen 361 bid size on the SPY. This is insane. The type of transactions happening on the level 2, it's insane. All right, 1234 on the West Coast. Thanks for stopping by and showing some love. Don't forget to subscribe here on Tradecaster. We're also dual streaming on YouTube. Show your boys some love here and subscribe on both platforms. Get our subscriptions up. Get our game up. Get our levels up. Yo, full disclosure, man, I haven't been trading a lot. I've just been really busy. My business is doing really well. Thank God. To God be the glory. But I've been really busy, man. And I just can't do both. I just can't. I got to focus on one. All right, we're holding strong here with Toquito in a live trade here. His target is 528 to the downside. Stop loss is 545. Staying patient on the 1 minute chart with about 25 minutes to go for the close. You are in Power Hour and you are tuned into the spread. I am Shimano Trader. Thanks for stopping by. Don't forget to subscribe. All right, VIX, little chill on the VIX here too. AMD pop and drop. Stuff recovered, but it's rolling over. Looks like a major bull trap there, possibly. Look at that. Look at the rollover on the SPY, guys. Check it out. It's in a matter of minutes. The 1 minute chart here. Starting to sell off. Getting a little bounce here at the 503, 504 level. 504 level, getting a little bounce on the SPY. We're chilling with Neo here and Toquito in a live trade here, trying to get to that 528 before the end of the session. Yo, if you're hanging out with us here on the chat, let us know where in the world are you? Where in the world are you joining us from? Love to know where in the world are you. Thanks for tuning in. You still got a couple of streamers up, right? I think we have a couple of guys still in the lobby. Rashawn's streams are usually up. It's not up right now. AK47, yeah, buddy, in the house. Prop trading with Liquid Vision and Alistair Trades are in the house. If you want to chill, stop by and say hello. Tell them the spread sent ya. Tell them Shimano Trade sent ya. Yeah, we'll be playing some live house right off the vinyl a couple times a week. So make sure you come back and visit us. If it's your first time popping by on the spread, make sure you come back and visit us. That's where you got to subscribe, man. That's where you got to subscribe, because then you get like a notification that we're on. And we're usually on every day, 30 minutes before the market open until close. And we just like to hang out when we got time to chill, hang out. Sometimes we trade, sometimes we don't. But sometimes we got people like Toquito we're actually copying his trade right now. So we would be short right now. Our stop loss is 545. Our target is 528. We got less than 30 minutes to go. Staying short. Things are rolling over and things are not holding after Powell. The first move is not the best move. Now we're starting to really roll over here, starting to get right back down to our pre-market high, which is about 502. Is it possible? Can we get there? Volume starting to come in on the downside. So hang tight, guys. Probably a little pop and drop here across the board. All things are popping and dropping. Toquito holding strong here. 528 first target. I told him I would have gotten out at this candle right here, at this pop right here at 1223 on the West Coast. On this move, on this break, I would have exited, but he held strong. So he's giving us a little bit more information about his trade and where he's at with it. We're riding that baby down. We're about to hit that new low here in regards to this little move that's coming down. We thought that was the bounce, and we just rolled over. Showing you how staying patient pays. Paciencia paga. See. All right, guys, got less than 30 minutes to go here. We're starting to get a real bigger. Oh, look at this. Oh, Toquito, man. Never panicked. I would have been like, I'm out. Premature exiter. All right, let me stop fucking with this chart, man. There. Let's watch it there.
Good luck, traders.
Yeah, man. Instead of sitting here watching your trade, just set your stop loss. But what are you trading though, Toki? You're trading shares here, right? Is this an option trade or is this a stock trade? Shares, yeah. Okay, cool. Because it's hard to do stop losses with options. So, yeah, man, I've been honestly, I'm gonna be the first where I'm gonna announce it here. I've been seriously considering just going back to shares. Just getting burned on options, man. It's because you lose your premium and you're screwed. You're clapped. At least with shares, you can come back, right, and be like, it spiked yesterday. I got out, something like that. But once your time is decayed, it's decayed. That's it. This looks really good here on the short. All right, this candle here, to me, is a reversal candle. I would, according to my way of trading and my rules, well, you wouldn't have learned much because I would have exited this short right here. But this candle here, like this little bit of a hammer here, doji candle, to me, usually is like a sign of a reversal, okay? That's just me. But Tokido's doing what Tokido's gonna do, so if he would have listened to me, he would have gotten out right here, and then he would have been like, see? So I'm gonna mark those just for my own entertainment. This would have been my exit, and to me, I would have been like, oh, caution right here on this candle. Yep, that's true too. Yeah, I'm thinking higher time frame. What I would do on a bigger time frame. Real live trading, real live teaching right here on the spread with Tokido in the house. Holding through this trade. I'm asking questions. He's correcting me, or at least giving me his perspective. And y'all benefiting from the knowledge. Your power hour got less than about 20 minutes to go. 20 minutes, 19 minutes to go. Whoa. 20 minutes to go before the end of the session. Powell has spoken, and he's sounding very dovish. We got a big pop while he was speaking during the press conference, and things are now rolled over. And we're bouncing at the top of this gap. We've been bouncing in and out of this gap because this is a long-term gap. This is a 1 minute chart here. You guys can see what the rollover has been on SPY. On the 1 minute, we can do 15 minute if you want. Look at those candles on the reversal right after Powell stopped speaking. 30-minute candles here. You can see those big flush that happened after Powell got off the mic. So big, almost reversal, complete reversal here with about less than 20 minutes to go. See if we can fill this completely candle up and it'll continue down. Sounds like bearish regardless, man. We've been, ever since we broke that rising wedge, we've been dumping on SPY for sure. All right, that's your SPY picture there. And we're going back to Neo because we are in a live trade here with Tokido. Tokido live in the house here in the chat room has been kind enough to share his trade and his position currently. So we've just copying it. And we'll see what we would have been doing here. Dude, I can't believe we're almost at your target, bro. That is awesome. Tokido, why are you shorting this stock? What is your thought analysis behind this trade? Like, why did you go short? And if especially we're looking at 1 minute, you're a 1 minute trader. It's a day trade. Why are you shorting the stock? If you can share that with us, that'd be great. $531 approaching target here on Neo. Watching a live trade here. Tokido's in this trade right now. Stop loss was 545. First target is 528 for an exit on a short. So I have 539 as a strong level from the weekly chart. and it rejected it twice before I took the previous reject down to 520, and I see no reason for something similar to work now again. Also, 520 is your real, is you think it can go as far as 520, but your target here is 528. Cool. That is such a cool thing. Wow, might even go 505 for the gap fill. 505. All right, we're watching here. 545, 15 minutes to go. 15 minutes to go here. Watching Neil sell off at the close. Got my boy, my homeboy, my brother from another mother, Tokido, placing a trade. Gave us his analysis in the chat, so you can check out the chat to see what his thought process was. We're on the 5-minute chart here. First target is 528. Thinks he can go as far as 505, but he's not going to wait for that. Stop loss was 545. We are short. And then I was analyzing every single candle on the 1-minute chart, and he goes, you don't need to do that. And I also have a downtrend line where I had it in the 1-minute chart, and it broke that. I said, hey, I would exit here. He didn't. And he has a much, I think, understanding his trade a little bit, he has a much higher perspective, right? He has like the 3,000 foot view. I have like the 300 foot view. And at least that's the way I was looking at it. And he's looking at it from 3,000 feet. So he's seeing the much bigger picture. Had a pretty, he explained this trade very well in the chat. You know, just you wrote it out, kind of what he was seeing and why he's even in this trade. And he had to watch the trade develop and have it touch a certain level more than once before he felt confident enough to jump into that trade. So got to wait for those A+ setups, I think. You got to wait for those A+ setups. A+ setups is what you need to wait for. And ever since I've taken like a week break here, thankfully not because I've been getting burned, but necessarily because I've been busy with my own stuff. But taking a break has allowed me to kind of help me understand that sometimes I want to be in a trade just for the shits and giggles of it and not necessarily the best opportunity and the best trade. And by sitting around watching stocks without being in a position, it has allowed me that opportunity to really look at looking at trades develop, like being forced to wait and watch trades develop. Like today, for example, with SPY, right? Like today you had to wait. You had to wait. 528 coming soon here. Look at the fuckery going on here with SPY. We're popping on SPY here, or at least trying to recover a bit here. Back to NEO though. 528 target coming in here for Tokido with less than 15 minutes to go. Will we get there? Will we get there? Will we not? Will we? Yeah, don't forget to like and subscribe here on YouTube. We're also on Tradecaster dual streaming today. Thank you for your love and support and stopping by and saying hello. Power hour with less than 15 minutes to go here, holding strong for that 528. Watching the level 2 is stacked. Traffic, a lot of traffic there. Here we go, 531, bouncing between that little level. Looks like a little strong level here, right? We've had a couple of bounces at this level here. All right, shout out to Sean recovering. He was down 5,000. Jesus Cristo. He was down $5,000 at the point today. Whoa, but he held strong, baby. He gave us his whole game plan, I think. Shout out to Sean, making that money, baby, making that moolah, baby. That's what it's all about, getting good at what you do. Yeah, this level's holding good here. Got less, about 10 minutes to go. 10 minutes to go here. Toquito, let us know if you jump out of this trade. That'd be great. Or if you got to go, whatever it is. Looks like you're going to get some suspense here, or you're going to have to exit here. But that's just me and my mindset. I mean, you've been holding good and strong. Looking at the level 2, man. Look at this, 424. Wow, man. That's millions of shares being traded here. It's probably because of the price. Yeah, the plan is the plan. The man with the plan. All right, man. We'll hold in here. 10 minutes to go. 10 minutes to go before the close of the session. Toquito holding strong. He says 528 or die trying. Yo, wifey just brought lunch in. Shout out to my wife. $531 holding here. Looking good, Toquito. Into the close here. Less than 10 minutes to go. Don't forget to like and subscribe here on the show on Tradecaster. We're also dual streaming on YouTube today. Thanks for hanging with us into the close here. Powell sounding very dovish. Higher for longer is the word of the day. Higher for longer is the word of the day and has been for several weeks now. As Powell is they're just gonna hold, man. They need more data. They don't know what the hell they're doing, and they're just trying to figure out what the hell they're gonna do. Remember the good old days? Oh, you're gonna have 3 rate cuts, possibly 4 next year. Ha! Now they're like, yeah, it's gonna be not in March. It'll be in the summer. Not in the summer. It'll be in September. You know what? Maybe not even this year. All right, hold in here. Look at the congestion on the level 2, man. That is insane. Oh my God, Toquito was right. 530. Cheers, guys. Oh, man. Holding strong. Toquito holding strong here for 528. With 8 minutes to go into the close. That's right. You're tuned in to The Spread. I am Shimano Trader. Follow me on Instagram. Follow the show here on Tradecaster. We're dual streaming today on YouTube as well. We also got a donation button. We don't know if it works, but feel free to use it if you want, if you must. You'll be the very first one. Oh, we start 529. Oh my God, we're gonna hit our target here with Toquito live in a trade right now. Watching Neil sell off. Well, it's not selling off, right? But I mean, it's falling here at the close. Trying to hit that 528 as the target. I'm gonna put an alert on it. See if it. Oh, that's it. It hit it. It already hit it. It's 528, dummy. Oh my God, I kept putting 530. Oh, there it is. Got the alarm, 528. All right, 7 minutes to go here. Looks like we're gonna hit our target. Good job, Toquito, holding strong, man. All right, target hit. We did. Oh, there it is, 528, Toquito. Congratulations, sir. Congratulations. We are hitting that 528. Looks like, I don't know if you're sold out of that or you had that already set up, but automatically took it. But we're there, 528. Good job, sir. All right, final 5 minutes of the day. We have hit our target of 528. I don't know if Toquito's still holding, if he's exited his position. Held strong through the whippling and the zigs and the zags. My man held strong. 528 currently is where we're at. Congratulations on that trade if you took it as well. If this is your first time joining us here on The Spread, do not forget to subscribe here to the channel. We love your support. And if you ever want to do a live trade here with us and want to watch it together and broadcast it together, please come by and stop by and let us know. Whoa, 522, baby. So you're selling half here, Toquito? Are you selling half here or you're completely out at 528? Notice the terminology, covered half, right? I said, are you selling half? I told him. And he's like, I'm covering half because it's in a short. So he's covering the short. It speaks to the level of professionalism in this trade. Yo, so shout out to all everybody. Toquito, if you guys took that trade with Toquito holding strong on the short. Toquito, what was your position size, if you don't mind us asking? Well, you took a pretty big position. Was it small, medium, large? There you go. 400 shares, baby. All right, 3 minutes to go here. 3 minutes to go. Hovering and hanging around this 528. If we break this 528, 529, I think we have a lot more room to flesh. But we're running out of time here with 3 minutes to go. Oh, you if you're doing shares, you could even close after the market closes, right? You can hold this into the aftermarket. Exactly. See, if you were an options trader, you'd be like, you better get out. You better get out. So, yeah, man, definitely reconsidering the strategies or just switching to, right? I mean, I do shares also, but I usually broadcast option trades. But we might have to switch that up. Yo, everything reversed nasty, man. Everything reflipped back around again. We're going to be down. We're up as much as 60 points on the S&P 500. Now we're down 1491, down 0.3%. VIX jumping here to 1542. Big old bull trap, guys. Bitcoin also flushing 56,813, 56,813, 2914 on Ethereum. Everything just, it popped and then it dropped right after Jerome Powell spoke today. The dollar, higher for longer, staying strong, 106.12. Tenure did pull back to 4.63, got as high as 4.70. All right. Kind of last seconds of the day here. Toquito was kind enough today to allow us to be part of his trade and be part of his position here. He is holding his shares into the close. Unlike options, you can hold your shares into the close, and then if you need to exit there, you can in the aftermarket. We've got about 10 seconds to go here at the close, guys. Just want to take a moment to thank everybody that hung out with us today for the FOMC meeting and the notes and watching the price action. Thanks for being part of our day. Thanks for hanging around with us. Do not forget to like and subscribe here on Tradecaster. We're also dual streaming on YouTube. Thank you for being part of our day today. There you go. That's your close, guys. That is your close. We ended down for the day. Down for the day. Another red day. Yo, shout out to Toquito for letting us be part of his trade today. Thank you again, sir. Always welcome on this show and on this platform. Thanks for always showing some love and support there, guys. All right, guys, I got to bounce. Thanks for hanging out again. Again, we're here every day, 30 minutes before market opens until the market close. And we have some fun sometimes. Sometimes it's just music. Sometimes we're trading. We are just definitely going to be structuring the show as time allows. But for now, thanks for being here. I will be here. If not, my stream will be here. And thank you, Toquito, for giving us your feedback with the audio and also letting me know that if I'm not going to be commentating or be on air with the stream, I should let people know like off air right now or not on the mic or something like that. I will take that in consideration, sir. Again, shout out to everybody who stopped by. Thanks for being here. If you were in the chat and participated in this entire transaction or this entire process here, make sure you let us know where you're joining us from and make yourself known and speak up. All right, guys, thanks for being here. We'll see you tomorrow. Have a great one. Bye.